Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with revision of very important topic, one of the most important topic of CA Final, that is non-resident taxation. We will try to cover up every aspect of this chapter which we have done in class in great detail with proper interlinking wherever required. Okay, so without wasting any further time, let us start with the discussion of non-resident taxation. The very first thing that we have to discuss over here is the scope of total income. Whose income is taxable in India? That depends upon two factors. One, it depends upon residential status, and second, it depends upon place of accrual and place of receipt. So if you are a resident and ordinary resident, then world income is taxable. Whether the income is accrued in India, accrued outside India, it doesn't matter, it is always taxable. If you are an NOR and NR, then both of them are almost same except one place. NOR and NR will be taxable when the income is accrued in India or deemed to accrue in India, or it is received in India or deemed to receive in India. Either of the two things should happen. Either the income should accrue in India, or either the income should receive in India, or either income should deem to accrue in India, or either income should deem to receive in India. There has to be some relationship with India, or else NR or NOR will not be liable to tax in India. Then what is the difference between NOR and NR? The difference comes only because of one item, and that one item is if the business is controlled from India and the profession is set up in India, even though the business is accrued outside India, business accrued outside India but controlled from India, profession accrued outside India but set up in India, then in that case also NOR will be liable to pay tax, NR will not be liable to pay tax. That's the only difference between what NOR and NR. NOR and NR will differ only in PGBP. They will not differ in salary, they will not differ in IFOS, they will not differ in capital gains, they will not differ in house property. They will only differ where? In PGBP. So let me conclude once again that if you are R and OR, resident and ordinary resident, then world income is taxable. You don't have to check all these things, where it is accrued, where it is received, where it is deemed to accrue, where it is deemed to receive. It is always taxable. If you are NR and NOR, then it is only taxable if it is accrued in India, received in India. If it is accrued outside India as well as received outside India, NOR and NR will not be liable to pay tax in India. Third case, only one case NOR and NR will differ, and that is PGBP. If the business is done outside India or profession is done outside India, but the business is controlled from India or the profession is set up in India, NOR has to pay tax, NR will still not pay tax in that case. Now, what do I mean by the term accrued? Accrued means income should be generated from India. Income should be having the source of income in India, or the generation should be from India. What do I mean by the term received? Received means where it is received for the first time. Suppose the money is received first time in London, then it is subsequently remitted to India. Then it will not be said that it is received in India. It will be said that it is received in London only. Therefore, where it is received for the first time, that is important. Subsequent remittance is not important. Sir, what do you mean by income deemed to accrue or arise in India? That we will see later in this chapter. In this chapter only, in the later part, we are going to see that. Sir, what do you mean by income deemed to receive in India? Income deemed to receive in India is defined in section 7, and there are three things which come in this particular thing. First, contribution in excess of 12% of salary to recognized provident fund. So whatever contribution you make to the recognized provident fund in excess of 12% of salary, that is deemed to be taxable in your hand, and it is deemed to be received in your hand. Or whatever interest is accumulated in excess of 9.5%. So the total interest accrued in your PF account is 12%. So whatever is in excess of 9%, that is 2.5% in this case, that will be deemed to be received in your case. Second, contribution by employer under a pension scheme referred under 80CCD. So whatever employer contributes for you under 80CCD, that pension scheme, whatever employer contributes, that is deemed to be received in the hands of the employee, and the employee has to add that to his salary income. Next, if you transfer from unrecognized provident fund to recognized provident fund, then also it is deemed to be received, but only whose contribution? Only employer's contribution and the interest thereon. Employee contribution and interest thereon is not deemed to received in the hands of the employee. So these are the three cases which are deemed to be received in India. Therefore, if you ask me honestly, these are not very much relevant because these are all salary specific provision, and salary chapter is not there in your CA final syllabus. Yes, the first paragraph is important, the second paragraph is not important. Now we are going to start from your residential status. First, we are going to talk about the residential status of individual. When an individual is said to be resident, for that we have created four categories. Category 1, there are two cases. Case 1, an individual is said to be resident if he stays in India for at least 182 days or more in the current previous year, or if this condition is not fulfilled, then one more criteria is there in which this is to fulfill two conditions. 60 days in the current previous year 25-26 and 365 days in the last 4 previous years. So either in the current year 25-26, if a person stays in India, if an individual stays in India for 182 days, then he is resident, or if in the current year he does not stay for 182 days, then in the current year he has to stay for at least 60 days, and in the last 4 years he has to stay for how much? 365 days. Then he will be called as resident and or a resident in India. If either of the condition is fulfilled, in case 1 there is 1 condition, and in case 2 there is how much condition? There is 2 condition. Once this is fulfilled, you have to classify a person as ordinary resident. When a person can be called as ordinary resident? To become ordinary resident, a person has to fulfill 2 more additional conditions. If both the conditions are fulfilled, he will be ordinary resident. If one of the condition is not fulfilled, he will be called as only resident but not ordinary resident. So what are the 2 conditions? First, out of the last 10 years, he should be resident in at least 2 out of last 10 years. Exclude the current year 25-26 and last 10 years count. Count the last 10 years, and out of that 10 years, he should be resident in any 2 years. Only one condition is not sufficient. Second condition is, in the last 7 years, he should stay in India for how many days? For 730 days or more. If these 2 conditions are fulfilled, then he will be called as what? Resident but ordinary resident. If either of the conditions are violated, then he will be called as resident but not ordinary resident. He cannot be called as what? Resident but ordinary resident. I hope it is clear to all of you. Next one. Category 2. Always remember, category 1 is applicable to all cases of individual. Whether you are an Indian citizen, foreign citizen, whether you are a person of Indian origin or not person of Indian origin, it doesn't matter. Category 1 is for everyone. But category 2, 3 and 4 is only for specific people. Like category 2. Category 2 is only for Indian citizen. Indian citizen who is leaving India during the previous year. During the previous year 25-26, you are leaving India as in 2 capacity, as a crew member of an Indian ship or for the purpose of employment outside India. So if these 4 conditions are fulfilled, Indian citizen leaving India during the previous year only for 2 purposes, as a crew member of Indian ship or for the purpose of employment outside India, then only 182 days criteria is applicable for you. 60 plus 365, this criteria is not applicable for you. Only 182 days criteria is applicable for you in exception 2. In that also, there is one rule which has been made for simplicity of calculation of number of days. Suppose an individual who is a citizen of India who is working in a foreign going ship, Indian ship which is going to foreign country, how will you count the period of stay in India? So the law says that as per rule 126, if an Indian citizen who is going outside India in a foreign going ship in an Indian ship, then the period starting from the date entered in continuous discharge certificate, the date on which you enter your sign in the continuous discharge certificate, from that day till the date on which you sign off in the continuous discharge certificate, that much period will be excluded for the purpose of what? For the purpose of stay in India. What is continuous discharge certificate? That I have explained you in the class. It's a kind of passport for seafarers who travel in sea. Every time you travel in sea, you are a crew member of a ship, you have to carry that particular continuous discharge certificate, you have to give it to the captain. Captain will sign in when you enter the ship. When you leave the ship after the journey is over, at that time the captain will sign off, and therefore from sign in till sign off, whatever is the period, that period will be excluded for the purpose of what? Calculation of period of stay in India. I hope it is clear to all of you. So category 2 is very clear for 2 cases: Indian citizen leaving India during the previous year for the purpose of employment, or Indian citizen leaving India during the previous year as a crew member of Indian ship. For crew member of Indian ship, period entered in the day from the day entered start from the continuous discharge certificate, and day on which it is signed off in the continuous discharge certificate, that much period will be excluded for the purpose of what? For the purpose of foreign going ship. Now, category 3. What is category 3? Category 3 is applicable to Indian citizens once again. And one more person is coming here. Person of Indian origin. Sir, who is person of Indian origin? Person of Indian origin means I can be called as a person of Indian origin if I was born in undivided India, India, Pakistan, Bangladesh, or if my parents were born in undivided India, or if my grandparents, maternal or paternal, either of the grandparents were born in undivided India, then I will be called as what? Person of Indian origin. So if I am an Indian citizen, or if I am a person of Indian origin, and if I visit India, visit means if I temporarily come to India. If I permanently come to India, I will go to category 1. If I visit India during the previous year for less than 120 days, then close your eyes and say non-resident. For 182 days or more, then close your eyes and say resident. In that case, if 2 additional conditions are fulfilled, then ordinary resident also possible. So if less than 120 days, close your eyes and say non-resident. If 182 days or more, close your eyes and say resident. In that case, in 182 days or more case, you can also be ordinary resident or not ordinary resident. But what about if you are staying somewhere in between? somewhere between 120 days to 181 days, then there are two possibilities. Either you can be not ordinary resident or non-resident. In this middle case, ordinary resident is not possible. In this middle case, either it is not ordinary resident or non-resident. So if you stay from 120 days to 181 days, and if you fulfill two conditions, then you are not ordinary resident. And if you don't fulfill the two conditions, then you are non-resident. Which are the two conditions? You should stay in India for 120 days to 181 days. Plus, you should stay in India in the last 4 years for 365 days. Plus, the Indian income should be more than 15 lakh rupees in the current previous year. The income from the total income from India other than foreign sources, the total income from India other than foreign sources should be more than how much? Should be more than 15 lakh rupees. If these three conditions are fulfilled, you will be called as resident and not ordinary resident. If either of the conditions are violated, then you will be called as not non-resident. Sir, how to count this 15 lakh? In this total income, if any business is done outside India or profession is done outside India, but the business is controlled from India or the profession is set up in India, then you have to consider that as a part of what? Part of Indian income. Suppose the business is done in Singapore, but it is controlled from India and you have earned 7 lakh rupees from that business, that will be considered to be Indian income for the purpose of this section. Be very careful with this. I hope it is clear to all of you. Now, category 4. Category 4 is a very special category where you do not have to stay even for a single day in India to become resident. Just fulfill 3 conditions, you will become resident. Here also you will always be not ordinary resident. Ordinary resident is not possible in category 3 also. So what are the conditions? Condition is Indian citizen you have to fulfill. Indian citizen. Then again the Indian income should be greater than 15 lakh. Again the same logic which is there in the previous section. And the Indian citizen is not liable to tax in any other country or territory. You should not be liable to tax in any other country or territory by reason of your domicile, residence or any other criteria of similar nature. So if these 3 conditions are fulfilled, first, Indian citizen has to be there. Second, the total income from India should be greater than 15 lakhs. Acha, tell me all of you, whether the income which is accrued, business which is accrued outside India but controlled from India, will you take that in 15 lakhs? The answer is yes. Here also you will take that in 15 lakhs. And this person, individual, should not be liable to tax in any other country or territory out of India. If these 3 conditions are fulfilled, you will be called as deemed resident. Liable to tax means what? Liable to tax means not only liable but also exempted liability will also be considered to be liable. If a person is liable to tax in India, chargeable to tax in India, and hence he is paying tax, that is also liable to tax. In second case, if a person is chargeable to tax in India and he is exempted through some notification in foreign country, that will also be considered to be what? Liable to tax in India. I hope it is clear to all of you. Next case, here we complete the residential status of individual. Let's go ahead with some simple points, then we will go ahead with some very important points. Residential status of HUF. When an HUF will be called as resident, an HUF will be called as resident when the control and management of the HUF is wholly in India or partly in India. Even if it is partly in India, it will be called as resident. Can an HUF be ordinary resident? Yes. If the Karta fulfills 2 conditions, additional conditions, then HUF will be called as ordinary resident. If the Karta does not fulfill 2 additional conditions, HUF will not be called as ordinary resident. Now always remember, only individuals and HUF can be called as ordinary, not ordinary. Rest all associates will be either residents or non-resident. Like firm will be either resident, non-resident. Company will be either resident, non-resident. There is no concept of ordinary, not ordinary in case of firm and company and etc. Ordinary, not ordinary is only there for individuals and HUF. Now firm, when a AOP, when a BOI will become resident in India, if the control and management again is wholly or partly in India, just like what? Just like HUF. Exactly like HUF. If the control and management is wholly or partly in India, they are resident. If the control and management is completely outside India, then they will become what? They will become non-resident. I hope it is clear to all of you. So let's go ahead with the next part now, that is the residential status of a company, which is a very important part for your examination, which is given under section 6, subsection 3. When a company is said to be resident, there are 2 types of company which are said to be resident. First, an Indian company is always resident. Indian company means what? Which is registered under the Companies Act 2013 or Companies Act 1956, as the case may be. So whenever a company is an Indian company, by default close your eyes and say that it is a resident company. What about a company which is not an Indian company, which is registered outside India? So if a company is registered outside India, which is not an Indian company, can also become resident in India if the place of effective management of that company in the current year is in India. So if the place of effective management is in India, that company can also be resident in India. So 2 companies. First, if a company is an Indian company, it is by default a resident company. If the company is incorporated outside India, then it can become resident if the place of effective management is in India. Sir, what do you mean by place of effective management? Place of effective management means a place where the key management and commercial decisions of the businesses are made. So if the key management and commercial decisions of the businesses are made in India, then India will be called as what? India will be called as the place of effective management. Now, to further explain this in detail, the CBDT has given a guideline, and this guideline has divided all the companies into two parts. First part, where the active business is outside India, and second part, where there is no active business outside India. But remember, this guideline is only applicable to companies whose turnover is more than 50 crore rupees. So if the turnover of the company in financial year 25-26, that is in the current financial year, is more than 50 crore, then this guideline is applicable. Once this guideline is applicable, first thing which we have to see is whether the active business is outside India or not. If the active business is outside India, then in that case, the poem is outside India. And if the poem is outside India, then you can say that the company is a non-resident. Now, obviously, you are doing all these things for whom? Are you doing this for Indian company? No, 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 no. Indian companies are always resident. We are not doing this for Indian company. We are doing this for companies which are incorporated outside India. POEM is not tested for Indian companies. POEM is tested for companies which are incorporated where? Which are incorporated outside India. I hope it is clear to all of you. Now. Let's talk about this circular very, very properly, because this is one of the most important part of the discussion of POEM. So, when a company's active business will be outside India, active business will be outside India if the company fulfills 5 conditions, 4 plus 1. If 5 conditions are fulfilled, the active business will be outside India, and if the active business is outside India, the poem will be outside India, and if the poem is outside India, then the company will be called as non-resident. The first condition is the passive income is less than equal to 50% of total income. It is less than equal over here. In next 3 point, it is less than 50%, but in first point, it is less than equal to 50%. So be very careful with that. So if the passive income is less than equal to 50% of total income, then your condition number 1 is fulfilled. Sir, what is passive income? In passive income, there are 2 types of income which comes. First, income where both purchase and sale are from associate enterprise. If I purchase from associate enterprise and sell to associate enterprise, it will be called as passive income. If I purchase from associated and sell to non-associated, it will not be passive income. If I purchase from non-associated and sell to associated, then also it will not be called as what? Passive income. Both purchase and sale should be from associate enterprise. Second category of income which will always be passive is 5 incomes which will always be passive. Royalty, always passive. Capital gains, always passive. Rental, always passive. Dividend, always passive. And last one, interest, always passive. But for money lending business, income, interest may not be considered to be passive income. For money lending business, interest may not be a passive income. I hope it is clear to all of you. So this is your condition number 1. What is condition number 2? Your Indian asset should be less than 50% of the total assets. So take the total assets in the denominator, take Indian assets in the numerator, and find out the percentage. The Indian assets has to be less than 50% of the total assets. The assets have to be calculated how? For depreciable assets, take the average at the beginning and at the end of the year, and for other assets, take the book value of the assets. Okay. Book value of the assets you can take at the end of the financial year. So for depreciable assets, you can take the average at the beginning and at the end of the year. And for other assets, you can take for cash, bank, stock, investments, you can take the 31st March value, that is book value. Third condition, the employees which are resident in India or which are situated in India should be less than 50% of the total employees. So find out the total employees, take in the denominator, and in the numerator take the employees which are situated in India or which are resident in India. That percentage has to be less than 50%. Employees will not only include payroll employees but will also include contractual employees. Any employee which is working on a contract basis but which is functioning in a similar manner, that will also be part of what? Employees. Employees need not be payroll employees, it can also be a contractual employees. Employees, how to count employees, sir? You have to take the average of the employees at the beginning and at the end of the year, 1st April, 31st March, divide by 2 and find out the employees. Now, the employees who are in India or employees who are resident in India, their payroll expense should also be less than 50% of the total expense. So, whatever employees are there in point number 3, their payroll expense also in amount percentage, in amount form, the amount form should also be less than 50% of the total payroll expenses. I hope it is clear to all of you. If you fulfill these 4 conditions, you can say that ABOI test is passed. Now one more condition has to be tested. After these 4 conditions are fulfilled, you have to fulfill the 5th condition. Once 5th condition will be fulfilled, you can safely say that your poem is outside India, and once your poem is outside India, you can say that your residential status is outside India, you are non-resident in India. What is the 5th condition? Majority of the board meeting should be held outside India, provided the board should take decision outside India. If majority of the board meetings, suppose the company has kept 10 board meetings, out of which 7 board meetings are held outside India, this condition is fulfilled, provided the board should have the power to take commercial and management decisions outside India. If majority of the board meetings are held outside India, but the management and commercial decisions are taken by a person resident in India or by the parent company in India, then this condition will be considered to be violated. Okay, as I have said you in the class, if majority of the board meetings of the Reliance Industries are held outside India, but the major decisions are taken by Mukesh Ambani in India, then this condition will be said to be violated. But in this also there is one exception, that if a holding company in India, that is Reliance Industry in India, makes a common policy for everyone, like HR policy, like finance policy, like accounting policy, like IT policies, so many policies a company can make. So if Reliance Industry in India is making a common policy for the entire company, not dedicated to any particular entity, then these conditions will be said to be fulfilled. Okay, now all these conditions you have to take average of current year and last 2 years if the data is given. If the data is not given, you can take a shorter period also. So in the exam they will directly give you average of 3 years. You don't have to do average of 3 years. Generally it will become very lengthy if you have to do average of 3 years. So they will give you average of 3 years in the exam. If they have not given, then you can take a shorter period also. So if you fulfill these 5 conditions, your active business outside India, your poem is outside India, and you are a non-resident. What if I violate any of the condition? If you violate any of the condition, then you have to go to the second part. In second part, first you have to identify the person who has the power to make key management and commercial decisions. Then you have to identify the place where key management and commercial decisions are taken. First find out the person who is liable to make key management and commercial decisions, then find out the place where key management and commercial decisions are taken. The place where the decision is taken is more important than the place where the decision is implemented. Where the decision is implemented is of no use. Where the decision is taken, it is of more use. I hope it is clear to all of you. Next one, you have to find out now other guiding principles. Lot of guiding principles you have to check, and you have to collect lot of evidences to prove that the residential status, the poem of the company is in India. Like you can find out the location of the board meetings. The location of the board of directors meeting is in India, then the poem can be said to be in India. Then you can check guiding factor 2. If the board has delegated some authority, some important work to some committees like management committee, executive committee, remuneration committee, like CSR committee, then you have to find out where the members are based and where they develop and formulate key management decisions. Then you have guiding factor number 3. Then you need to find out the location of the head office. The location of the head office can be a very important factor because most of the big decisions of a company are taken at head office only. So such place can also be considered to be poem. Then you need to find out the residence of the directors, because wherever generally director reside, that is the place where they take all the key management and commercial decisions. So if the directors are residing in India and they are taking key management and commercial decisions, that place can also be considered to be place of effective management. Then you need to find out where circular resolution or round robin voting is done. What is a circular resolution? It is given under section 175 of Companies Act 2013, which I have told you in the class, that one director will pass the resolution at his home and then pass on to other director at then the other director will pass the resolution at its home. Nobody will meet to each other. They will pass the resolution to each other and they will pass a particular project or particular thing will be processed through that particular resolution. Therefore, a circular resolution can also be important to determine the residential status. A circular resolution can also be important to determine the place of effective management. So try to find out who has the authority to pass what? The circular resolution. Next one, location of strategic shareholder. Generally, shareholder is not important to determine the residential status. Generally, shareholder is not important to determine the commercial management and decision, because generally what happens, commercial management and decisions are not taken asking the shareholders. Shareholder is separate, management is separate. It is the management who will take the decision, not the shareholder. But if the shareholder is a strategic shareholder, then in that case, the shareholder's opinion can also matter, and therefore the location of shareholders can also be important in this case. After all these factors also, if you are not able to identify the poem of a particular company, then there are some secondary factors. Find out where the substantial activity of the company is taken out, is done. Where the substantial activity is done by the company, that place can be called as the place of effective management. And find out where the accounting records of the company are kept. Once you find out these things, Even after that, if you are not able to find out, then you have to take all these things. It is the duty of the assessing officer to gather maximum evidence against the assessee. If he is able to gather maximum evidence against the assessee, then he can prove that the poem is in India. No single circumstance can be deciding factor. No single guiding factor can be sufficient. Only one condition is not sufficient to decide whether the poem of a company is in India or not. There has to be series of events which has to happen. Therefore, whether a company's poem is in India or outside India, it all depends upon the facts and circumstances of every case. The law says, the circular says, no single principle can be decisive. Just because foreign company is owned by an Indian company, that does not mean that the foreign company has a poem in India. Just because directors are residing in India, that does not mean that the poem is in India. Just because the company has a local management in India, that does not mean the poem is in India. Just because the foreign company has a license office in India, that does not mean that the poem is in India. One single factor cannot be decisive factor. A series of events has to happen to decide, to prove that, to establish the fact that the foreign company has a poem in India. I hope it is clear to all of you. Now, once the assessing officer knows that the poem is in India, he will initiate the proceeding and he will send a notice to the assessee. He will send a notice to the foreign company declaring that the poem is in India after taking prior approval of commissioner. So the AO will issue a notice, a show cause notice to the assessee, that is to the foreign company, saying that show me a cause why your poem should not be declared in India. And he will do this, he will issue this notice by taking an approval from commissioner. After, the proceeding will go on for a few months, and then the AO will hold that the foreign company has a poem in India after taking an approval from a collegium. A collegium is a group of 3 commissioner of income tax. So to initiate the proceeding, he will take approval from 1 commissioner, and to conclude the proceeding, he will take approval from 3 commissioners. And these 3 commissioners will also be appointed by whom? Will also be appointed by a chief commissioner. I hope it is clear to all of you. Now let's go ahead to the next part, which is an extension of poem discussion only. A separate section is brought by CBDT 115JH and its notification 29/2018. What is the use of this particular notification and this section? This notification and this section talks about when a company becomes resident because of poem for the first time. There are a lot of questions which can come to our mind. All those questions are answered in this particular notification and this section. So suppose 25-26, first time a foreign company has become what? A resident in India due to poem. Now a lot of questions will come. First, whether they will be eligible for depreciation on their assets which are there in UK. For example, the company is located in UK and now they have become resident in India due to poem. So whether they will be eligible for depreciation, and if yes, what will be the WDV of their asset? So let's talk about that. In that case, first possibility is you need to find out whether there is a taxation system in UK or not. If there is a taxation system in UK, and if depreciation is allowed in that country, if there is a taxation system in UK and if depreciation is allowed in that country, then whatever is WDV as per their taxation law, that will become the WDV under the income tax law on 1st April 2025. Second possibility, there is a taxation system in UK, but the depreciation was not allowed because of some reason in that country. Then you have to compute the WDV, assuming that what would have been the WDV if depreciation would have been allowed in that country. For example, the foreign company is located in UK, their taxation system is there, but the depreciation was not allowed to that company because maybe that foreign company may be following some presumptive income in that nation. Therefore, you have to presume that if depreciation would have been allowed, then what would have been the WDV? Okay. Third possibility, if taxation system is not there in that country, then you have to determine the WDV as per the books of accounts. So this is the first question which they have answered. The second question, which is a very big question, what about the losses of the foreign company and unabsorbed depreciation of the foreign company? Don't worry, we will allow you the losses of the foreign company. We will allow you the unabsorbed depreciation of the foreign company in the current year when the company will become resident due to poem in the current year. Now a lot of questions will come. Question number 1, which losses? Again, if there is a tax over there, then tax losses, tax UAD. If there is no tax over there, then believe me, you will also be allowed to set off the accounting losses and accounting UAD in India. This is the first thing that we need to answer. Second. The losses will be allowed for how many years? Will it be allowed for another 8 years, another 4 years? No, it will be allowed for balance number of years. Such loss and UAD will be allowed for balance number of years. The loss will be allowed for balance number of years, and for UAD there is no time limit. Obviously, we know that. Third condition, such losses and UAD can set off against which income? It can only set off against income which is accrued outside India or received outside India. It cannot set off against income which is accrued in India or which is received in India. Any income which is accrued in India or which is received in India, such losses which are incurred outside India cannot be set off against that. You can only set off against income which is accrued outside India or income which is received outside India. Next, what if in the foreign country such losses are revised later on by the foreign tax jurisdiction? Suppose today the loss which we are carrying forward in India is 10 lakh rupees. Now suppose in future there is something like income escaping assessment which has reopened in foreign country. So in that case the loss has been reduced to 7 lakh. So I also have to change the losses in India according to that. I hope it is clear to all of you. Now, how should I carry forward the losses in case my P&L, my financial year and the financial year of that country is not same? If my financial year is from April to March and that country's financial year is also from April to March, then there is no issue. But if my financial year and the financial year of that country does not match, suppose I follow April to March and that country follows Jan to December, then what to do? Then you have to check the interim period. Let me give you one example. Suppose on 1st of April 2025, the company has become resident in India due to POEM. When the company has become resident in India, 1st April 2025, the company has become resident due to POEM. And then you have to check the last financial year of that company. Suppose the last financial year is the calendar year of that country. Suppose it starts from 1st January 2024 and it ends on 31st December 2024. Then you have to check that interim period, that middle period, leftover period. If this leftover period is less than 6 months, if it is less than 6 months, then you have to merge with this particular year and make one single year of 15 months. If this interim period is more than 6 months, then you have to consider this 12 months as a separate period, and this middle period which is more than 6 months, that has to be considered as a separate period. So you have to first find out in which year you have become resident, then you have to find out the last financial year as per that country, and if there is an interim period which is less than 6 months, then merge to the preceding year, and if it is more than 6 months, then take this as a separate year and take this as a separate year. I hope it is clear to all of you. This is what we have done in the class also. Sir, whether if once, sir, is this company becoming resident in India? Yes, this company is becoming resident in India. Sir, is this company also a foreign company? Yes, this company is also a foreign company. So, sir, if somebody makes payment to this company, they will deduct TDS as per what? By considering this company as a resident or by considering this company as a foreign company. Therefore, the answer is you will treat this company as a foreign company and deduct TDS under 195. For example, you are making payment of professional fees to this company. Then whether should I deduct TDS under 194J considering it as resident, or whether should I deduct TDS under 195 considering it as a foreign company? You have to consider this as a foreign company and deduct TDS. I hope it is clear to all of you. Sir, since this company has become resident in India, whether the Indian government will give the relief under section 90 and 91? The answer is yes. The Indian government will give relief under section 90 and 91 because ultimately this company has become the resident of India and it is the duty of the government of India to give relief to residents. Okay, next one. Sir, whether these benefits will be available for subsequent years also? Yes, these benefits will also be available for subsequent years. It is not applicable only for 1 year. It will also be applicable to subsequent years. Next, sir, is this a foreign company? Yes, it is a foreign company. Then all the provisions of foreign company shall continue to apply to it. Sir, is this a non-resident? No, it is not a non-resident. It is a resident now. Therefore, the provisions of non-resident will not apply to this particular company. So, in whichever provision in the entire income tax law in 298th section, only word foreign company is written, you can continue to apply the provision to this particular company also. In whichever provision the word non-resident is exclusively written, only non-resident, then this company will not be eligible to that benefit. In whichever section there is the word written resident, then this company will definitely be liable for benefit of that particular section because this is ultimately a resident. So wherever foreign company is written, you can enjoy the benefit. Wherever resident is written, you can enjoy the benefit. But wherever non-resident is written, you cannot enjoy the benefit of that particular section. Last but not least, sir, what will be the tax rate of this company? The tax rate will be same as the foreign company, that is 35%, surcharge of 2% and 5%, and cess of 4%. I hope it is clear to all of you. Next section, section 285. It's a small discussion on submission of statement by non-resident having a license office in India. Every non-resident have a license office in India. They have to submit a statement to the assessing officer in prescribed form on within the prescribed period. So what is the prescribed form? Every non-resident having a license office in India has to submit a statement to whom? To the assessing officer in prescribed form 49C. Within how much time prescribed period is? Prescribed period is within 8 months from the end of the financial year. So financial year ends within 8 months from the end of the financial year, you have to submit that particular statement to the assessing officer. If you fail to submit that statement, the assessing officer will impose penalty under 271 GC. How much? For first 3 months, it will be 1000 rupees for every day, and after that it will be 1 lakh rupees. An opportunity of being heard will be given to you in that case. So first 3 months it is 1000 rupees for every day, and after that it is 1 lakh rupees flat, and opportunity of being heard will obviously be given to you. Next issue, clarification of non-resident seafarer. Suppose I am doing a job in a shipping company. Suppose if I am doing a job in shipping company and most of the time I am outside India, and I am receiving my salary in India in an NRE account, then that salary will be exempt under the income tax law. So amount of salary received by whom? By a non-resident seafarer. In what? In your NRE account. If it is received in non-resident external account, then it is exempt. If it is received in non-resident ordinary account, NRO account, then it will be taxable. Therefore, if you want to make your salary exempt, then you have to receive in NRE account. And this benefit is only for non-resident seafarers. It is not for chartered accountants or doctors or lawyers or other professions or other businesses. It is only for non-resident seafarers. I hope it is clear to all of you. Now, from here onwards, we are going to start with very important discussion. When interest is taxable in India, when interest is accrued in India, and we are going to talk about the taxability of interest in great detail from here onwards. Interest, royalty, and FTS. These are the three incomes we are going to talk in great detail from here onwards. First of all, we will talk about the accrual. When interest is accrued in India, first of all, interest is deemed to accrue in India if it is payable by government. If the government pays interest to anybody, it is always accrued in India. Second, if the interest is paid by a resident in India, then also it is accrued in India. But, if a resident borrows money and use the money outside India for business and profession, or use the money outside India for any other purpose, then it will not be deemed to accrue in India. See, for government, this exception is not applicable. If a government borrows the money and uses in Nepal, then also this interest is deemed to accrue in India. I am government. I am raising money from non-resident and using that money in Nepal, and I am paying interest to non-resident, that is deemed to accrue in India. This exception is only for resident. This exception is not for government. But for resident, if they raise the money and if they use the money outside India for business and profession, and if they use the money outside India for other purpose, and if they pay the interest, then that interest will not be deemed to accrue in India. What about if an NR gives loan to another NR? One NR gives loan to another NR, and another NR use that money in India for business and profession, then it is taxable in India. But one NR gives loan to another NR, and the another NR uses that money in India for other purpose, not for business and profession, then it is not taxable in India. Be very careful. NR gives loan to another NR, and another NR use that money in India for business and profession, then whatever interest is paid by second NR to first NR, that will be taxable in India. But if that money is used in India for other purpose, for investing in shares, for investing in property, for investing in debentures, then the interest paid by second NR to first NR will not be subject to tax in India. I hope it is clear to all of you. Further, there is a great exemption for individuals from interest income. That is, if an individual earns interest on money standing in the NRE account in any bank in India, is exempt. So if I am an individual, if I am a money standing in the bank account, then interest lying in that bank account in NRE account will be exempt. Interest from saving account, interest from FD account, all kind of account in NRE account will be exempt. It is not saving, it is saving, FD, everything. If I am an individual and if I am an NRE account and if I earn interest from that NRE account, it is exempt. Okay, provided I should be a resident outside India as per the FEMA, or I should be a person who is permitted by RBI. I should be a person who is a resident outside India as per the FEMA laws, not as per the income tax law. I should be non-resident as per FEMA, or I should be the person who is permitted by RBI to maintain such account in India. Next one, sir, when royalty and FTS is taxable in India, it is same. First point, second point, exception is same like interest. Only point number 3 differs, so that I am talking about. First point same. If a government pays royalty, it is always accrued in India. Where it is used doesn't matter. It is used in India or outside India, it does not matter. It does not matter. It is always taxable in India. What about if a resident pays royalty? If a resident pays royalty, then you have to check. If he is using that royalty outside India for business and profession or other purpose, then it is not deemed to accrue in India. If he is using in India, then it is deemed to accrue in India. Third point is different. If one NR provided services to another NR, and another NR uses that service in India for business and profession, and now even for other purpose, this other purpose was not covered in interest, even for other purpose, that royalty and FTS will be subject to tax in India. Royalty is accrued in 916 and FTS is accrued in 917. I hope it is clear to all of you. Now, one explanation is below. in section 9, which is for royalty, FTS and interest. Remember, there are two things which you have to always keep in mind for royalty and FTS and interest. For royalty, FTS and interest, there is no need to have any business connection. There is no need to have any place of business. There is no need to have any kind of permanent establishment in India. Royalty, FTS and interest are not subject to tax in India because of place of business or business connection or permanent establishment. They are always taxable in India if you fulfill the conditions of 915, 916 and 917. That is, the services should be utilized in India, the money should be used in India. That's it. For royalty, FTS and interest, there is no need to have any kind of permanent establishment or business connection in India. One more thing, for royalty, FTS and interest, there is no need for the renderer, for the service provider to come to India and provide services. The service provider can provide services from outside India. What is relevant is that the services should be utilized in India. We have done all these things in great detail for hours and hours and hours. We have done all these things. I'm just trying to recap everything. I hope you are able to recall everything. So therefore, for royalty, FTS and interest, keep two things in mind. First of all, they are not subject to tax because of PE. Even if PE is not there, even if business connection is not there, royalty, FTS are subject to tax in India. Interest is subject to tax in India. Second, the service provider may or may not be in India. If he is in India, then great. If he is not in India, then also it is taxable. What is important is service should be utilized in India, and the service provider can provide services from outside India also. I hope it is clear to all of you. Now let's go ahead with the next part, that is taxability of interest, dividend and then royalty and FTS. First we will talk about taxability of interest in the hands of non-resident and foreign company. There are three different sections in 115A. 115A is the tax rate section, and 195, 194 LB and 194 LC are the TDS section. Let's talk about how non-resident and foreign company will be subject to tax under different categories of interest. First of all, who is the lender in first case? The lender in first case is non-resident and foreign company. Who is the borrower in first case? The borrower in first case is Indian concern. It's an Indian concern, not Indian company. Indian concern means any entity who is doing any business and profession in India can be called as Indian concern. Need not be Indian company. It can be Indian company also, but not only Indian company. The borrower can also be government. Tax rate 20% plus surcharge if applicable and cess. TDS rate is section 195. There is no concept of time limit over here. There is no concept of rate of interest approval over here. And the loan has to be given in foreign currency. The loan has to be in foreign currency in first case if you want to come under this case. Second case is again non-resident and foreign company is the assessee. Who is the borrower? The borrower is infrastructure debt fund whose own income is exempt under section what? Under section 1047. The income of infrastructure debt fund is exempt under section 1047. What is the tax rate over here? It is just 5%. 5% subject to surcharge if applicable and cess always. The TDS will be deducted under 194 LB. There is no time limit. There is no time limit unlike the third section. In first and second section, there is no time limit. In first and second section, there is no approval required from anybody. Last but not least, here the loan is in any currency. In second case, the loan need not be in foreign currency. It can be in foreign currency also. It can be in Indian currency also. But in first case, the loan has to be in the foreign currency only. Third section is a very important section because there are a lot of things in third section. Whatever is there in the third section only. Third section is again non-resident and foreign company is giving the loan and Indian company is taking the loan. Okay. Now, what is Indian company taking? Indian company is taking loan also and long-term bonds also in foreign currency. So first Indian company is taking loan in foreign currency. Second, Indian company is issuing bonds and they are taking money in foreign currency. And third, Indian company is also taking rupee denominated bond in any currency. Now these are the three instruments which are covered in this section. First, loan in foreign currency. Second, bond in foreign currency. Third is rupee denominated bond in any currency. Now let's talk about all of them one by one. If the money is borrowed after 30th June 2012 but till 30th June 2023, that is before 31st July 2023, then the tax rate will be 5% and 4% in some cases. Sir, when 5%, when 4%, that I am telling you in a while. If the money is borrowed after 1st July 2023, then the tax rate will be 9%. Now let's talk about all these things directly. Now be very careful. Be very, very careful. If the money, let's see the case 3 first. If the money is borrowed between 1st July 2012, but before 1st July 2023, and it is borrowed by long-term bonds or by loan or by rupee denominated bond, then the tax rate is 5%. Okay. So if the money is borrowed between what? 2012 to 2023 by long-term bond, by loan or rupee denominated bond, then the tax rate will be 5%. But if the money is borrowed between 2020 to 2023 and it is by long-term bond and rupee denominated bond which are listed on a recognized stock exchange in IFSC, this is not a normal bond. It is a bond which is listed in a recognized stock exchange in IFSC, then it is 4%. Similarly, if the money is borrowed between after 2023, because this case 1 expires on 1st July 2023. So after 1st July 2023, if you borrow the money by long-term bond or rupee denominated bond listed on a stock exchange in IFSC, then the tax rate is 9%. So there are three categories now. From 2000, again I am saying, from 2012 to 2023, if you borrow the money by loan or long-term bond or rupee denominated bond, it is 5%. But after 2020 to 2023, if you borrow the money by loan or rupee denominated bond listed in a recognized stock exchange in IFSC, then it is 4%. And after 2023, if you borrow the money, then it will be taxable at 9%. I hope it is clear to all of you. So now there are a few other things which we need to see. So when 5%, when 4%, when 9%, again I will say between 2012 to 2023, it is 5%. Between 2020 to 23, it is 4% subject to condition. That is, if the bonds and the rupee denominated bonds are listed in a recognized stock exchange in IFSC. After 2023, 5% section is expired because this section expires on 2023. After 2023, this 9% is still there, but that is only for IFSC listed bonds and IFSC listed rupee denominated bonds. It is not for other people. Now, in one case, rupee denominated bonds interests are completely exempt under section 10(4)(c). If the rupee denominated bonds are issued between 17 September 2018 to 31st March 2019, if the rupee denominated bond is issued between this period, then the interest is completely exempt under section 10(4)(c). No interest will be subject to tax. I hope it is clear to all of you. Last but not least, in this case, in this third interest, the TDS will be deducted under 194 LC. This should be approved by central government. The rate of interest should also be approved by the central government. It should not exceed the rate approved by the central government. If it exceeds the rate approved by central government, you cannot come under this section. I hope it is clear to all of you. Again, I am saying when 5%, 2012 to 2023, it is 5%. But after 2020 to 23, if it is in IFSC, two instruments, then 4%. After 2023, this 5% section is gone. If you borrow after 2023, this 5% section is gone. If you have borrowed earlier before 2023, yes, this 5% section can still continue. So after 2023, only 9% is possible now. Okay, I hope it is clear to all of you. Now, last but not least, if any loan is given by a non-resident to a unit in a IFSC and the money is borrowed on or after 1st September 2019, then it is fully exempt. So if the lender is a non-resident, the borrower is a unit of an IFSC and the lender is giving money to the unit of IFSC on and after 1st September 2019 and the borrower is paying the interest, then that interest is fully exempt under section 10(15) subclause number 9. I hope it is clear to all of you. This is how the interest will be subject to tax. Okay. So in the first interest, it is loan in foreign currency. In the third interest, for long-term loan and long-term bonds, it is foreign currency. For rupee denominated bond, it is any currency. In the second interest for infrastructure debt fund, it is any currency. Be careful with that. Okay. Now, how the dividend income will be taxable in the hands of non-resident? Normally, the dividend in the hands of non-resident will be subject to 20% tax. But if the dividend is received from a unit in IFSC, dividend is received from home, from a unit in IFSC, then it will be subject to 10% tax. So normally dividend income in the hands of non-resident foreign company will be subject to 20% tax. But if it is received from a unit in IFSC, then it will be subject to 10% tax. Now let's go ahead and talk about which all deductions will be allowed against the interest and dividend under 115A. Whether I will get the deduction of PGBP expenses? No, PGBP expenses will not be allowed from 28 to 44. IFOS expenses will not be allowed. Even UAD will not be allowed. What about losses? Yes, brought forward losses you can set off. What about chapter 6A? Chapter 6A will not be allowed except one chapter 6A will be allowed, that is 80LA. So only 80LA will be allowed to you. Therefore again I will say no PGBP expense will be allowed, no IFOS expense will be allowed, no brought forward losses, no UAD will be allowed. Brought forward losses you can claim if you have some other business in India, you can set off that business loss against this income. Okay. And chapter 6 is not allowed except one chapter 6A, that is 80LA. Only 80LA will be allowed, no other chapter 6A will be allowed. Sir, is the foreign company and non-resident liable to file the return? They are not liable to file the return if they fulfill two conditions. If they only earn this income and their TDS is deducted at a rate not less than the rate mentioned in 115A. So whatever is the rate mentioned in 115A, if the TDS is deducted as per that, and if they only earn this special income, there is no need to file the income tax return. Suppose the tax rate is 20% here, but the tax rate in this first case is 20%, but the DTAA says that it is 10%. Now, if the TDS is deducted as per DTAA, which is lower than 20%, which is lower than 115A, then they have to file the return. So if the tax is deducted as per this section, not as per the lower DTAA rate, and they only earn this income, then there is no need to file the income tax return. I hope it is clear to all of you. Sir, will the foreign company be liable to MAT on interest and dividend? They will not be liable to MAT on interest and dividend wherever their normal tax rate is more than what is less than what 15%. So wherever the normal tax rate is less than 15%, they are not liable for MAT. For example, in the first case, the normal tax rate is more than 15%. Therefore, here MAT will be applicable. In second and third case, the normal tax rate is less than 15%. Therefore, in second and third case, MAT will not be applicable to the foreign company. I hope it is clear to all of you. Now, let's talk about 115A, which talks about royalty and FTS if there is no P in India. See, if you want to come in 115A now, you have to fulfill two conditions. First, you should not have a permanent establishment in India. Second, there has to be an agreement between the SSE and the other party, SSE and Indian company, and that agreement should be approved by central government. If these words are not there in exam now, you cannot come in 115A. Then you have to tax the royalty and FTS as per the normal tax rate. For foreign company 35%, for other than foreign company whatever is the normal tax rate that you have to apply. Therefore, if you want to come under 115A, two conditions has to be fulfilled. First of all, there has to be no P in India, no permanent establishment in India. And second, the most important point which I am telling you again, that is the non-resident should have an agreement with Indian concern, and that agreement should be approved by central government. Unless these words are there, you will not be coming under 115A. Be very careful. Okay. Now, who is the service provider? Non-resident and foreign company are providing services. What services? Royalty, FTS. To whom? They are providing services to government or Indian concern. At what rate it will be taxable? It will be taxable at 20% or DTAA, whichever is lower. 20% subject to surcharge and cess, and DTAA rates which are not subject to surcharge and cess. Always remember, DTAA rates are never subject to surcharge and cess. So 20% or DTAA, whichever is lower, that will be the tax rate over here. Will they be liable for MAT? If the tax rate is less than 15%, then no MAT. If the tax rate is more than 15%, then MAT will be applicable. Now, what about the income? What about the deductions? Will I get any deductions from this? Again, no PGBP deductions, no IFOS deduction. Can I set off broad fraud losses? Yes. If there are some other businesses in which there is a loss, you can set off that loss against this income. Can I claim Chapter 6A from this royalty and FTS in 115A? Yes. In interest, it is not allowed. In interest, only 80LA is allowed. But here, all Chapter 6A you can claim against this income. I hope it is clear to all of you. Whether I am supposed to file the return, no need to file the return. Same logic. If you only earn this income and TDS is deducted as per 115A 20% tax rate. So if you only earn this income and TDS is deducted as per 115A, there is no need to file what? There is no need to file the income tax return in that case. I hope it is clear to all of you. Now there is one exemption given to some non-resident. If the non-resident and foreign company is providing some royalty or FTS to National Technical Research Organization in India, then that royalty and FTS is exempt. So who is the service provider? Non-resident and foreign company. Who is the service receiver? NTRO, National Technical Research Organization, which runs under the leadership of Prime Minister of India. Therefore, if such NTRO pays royalty and FTS to non-resident and foreign company, such non-resident and foreign company are not liable to pay tax in India. Now, sir, what do you mean by the term royalty? What do you mean by the term FTS? See, the term royalty and FTS is a very, very exhaustive definition. It has a long list, very, very long list, but there are some important points in that which we are going to see here. For understanding the definition of the term royalty and FTS, you have to check DTAA of each and every country properly. But yes, there are some things which you need to keep it in mind, which are given in the form of an explanation in section 9. There are three explanations which are given over here. Explanation 4, explanation 5 and explanation 6. There are some Supreme Court judgments also. We are going to see all of them one by one. Suppose, sir, if I buy some rights with respect to computer software, whether that will amount to royalty or not, that will amount to royalty. If you buy any rights with respect to computer software, that will amount to royalty, and therefore section 115A will apply, and you have to deduct TDS at the rate of 20% or DTAA, whichever is lower, and TDS has to be deducted under section 195. What will be the treatment in the hands of the payer? The payer royalty will not be treated as what? Block of asset. This computer software will not be treated as block, and it will be considered as a revenue expenditure subject to tax deduction. So remember, always you need to check the nature of service that you are taking. If you are taking the rights in respect of computer software, then it is a royalty. But if you are taking the computer software to resell it, you are not taking the rights of computer software. You are taking the computer software to resell, or you are taking the computer software for your end use in the business. Because suppose I am taking a software for the purpose of encryption for my students for giving lectures, then that is for end use. Or if I am taking the computer software for resale. So if these are three different things. If I take the rights of computer software, then it is a royalty. It's an expense, 115A will apply. But if I take it for resell, or if I take it for end use, then the Supreme Court of India in the case of Engineering Analysis Center of Excellence Private Limited versus CIT and another has held that it is not a royalty. It is not a royalty. It will not be considered to be a royalty, and therefore you cannot expense out. I hope it is clear to all of you. Similarly, I have given you some examples with respect to explanation 5 to section 9. There is a bank over here, SBI, who is giving you credit card. Now you are swiping the credit card in a particular shop. That credit card is going for what? Verification in a server. That server is owned by whom? A foreign company. That server is owned by Bank of Germany. So whatever amount you pay to that Bank of Germany, whether that will amount to royalty, the answer is yes. The answer is yes. Whatever amount you pay to that foreign company, that will also be subject to TDS. That will also be considered as royalty under the income tax law. Third one, there are Indian TV channels who wants to transmit their programs on television. So whatever programs they transmit on television, they make use of satellite. The satellites are owned by foreign companies. So whatever foreign company satellite you are using, you are making some payment to them. Whether that can be considered to be royalty, the answer is yes. In explanation 6 to section 9, it is written that whatever amount you pay for using the satellites of foreign company, that will be subject to what? That will be royalty, and you have to deduct TDS under 195. I hope it is clear to all of you. Similarly, whatever amount you pay for taking the domain name from GoDaddy.com, that cannot be treated as royalty. I want to take domain name aarishkhan.com for my website. GoDaddy.com sells domain names. So I want to purchase aarishkhan.com, aarishkhan.in, etc. Whatever website name I want, I need to purchase a domain from GoDaddy.com. So whatever domain name you purchase from GoDaddy.com, that does not amount to royalty, and therefore it cannot be subject to TDS under 195. I hope it is clear to all of you. So this is what 115A is all about. Now we will talk about 44DA. What is 44DA? If the same non-resident and foreign company is providing royalty and FTAs, and they have a permanent establishment in India, and they have an agreement which is approved by central government. Agreement and approval by central government is mandatory in 115A also, in 44DA also. In both the section it is mandatory. Agreement and approval by central government is mandatory in both the section. Therefore, we will have a comparison. So if there is a non-resident or foreign company which is providing royalty and FTAs and there is no P, then 115A will apply, and if there is a P, then 44DA will apply. But there is an agreement which is approved by central government is mandatory in both the section. Now we will compare both the section. In 115A, no expenses allowed. But in 44DA, you have a P in India, you have a branch in India through which you are operating, through which you are providing services, through which you are providing royalty and FTAs. Therefore, you will compute your PGBP income after allowing all the expenses. All expenses will be allowed to you subject to some condition. First, if any expense which is not wholly and exclusively for Indian branch, that will not be allowed. So the expense has to be wholly and exclusively for Indian branch, only then it will be allowed. If any expense which is not wholly and exclusively for Indian branch, that will not be allowed to you. Second, if there is an HO outside India and you are taking some services from HO and you are making the payment to HO, that will not be allowed. That will be considered as payment to self. If you have taken services from HO and making payment to them, that will not be allowed. That will be payment to self. That is disallowed. But if you have taken services from third party and you are telling your HO to make the payment and you are reimbursing to your HO, then that reimbursement will be allowed, because that is not payment to self, that is payment to third party. If the HO is providing services and you are making the payment, not allowed. But if third party is providing the services, you are reimbursing to HO, then that will be allowed as deduction. I hope it is clear to all of you. Then chapter 6A is allowed under 115A also, under 44D also. Losses of other businesses are allowed under 115A also, 44D also. In 115A, there is no need to maintain any books, but in 44DA, you have to maintain books. In 115A, there is no need to do any audit, but in 44DA, you have to do audit. In 115A, the tax rate is 20% or DTAA rate, whichever is lower. In 44DA, it is normal tax rate. For foreign company, it will be 30%. For others, it will be normal tax rate, whatever is applicable to an assessee. I hope it is clear to all of you. So this is where we complete the discussion of what? Interest, royalty and FTS completely. So let's go ahead to the next part. Now, after the discussion of interest, royalty and FTS, there is a small explanation. We will see that, and then we will go ahead with 115AB, 115AC, 115AD, and taxation of global depository receipts. Now, to understand this, we have taken one example, explanation to section 9. There is a Bank of America Indian branch, there is a Bank of America USA headquarters, and there is a Bank of America Singapore branch. Now what happens, the American branch and the Singapore branch is giving loans, and in return we are paying them interest. Okay. So now, and with that loan, we are giving that loan to consumers and industries in India. Now the question is, whether this interest which we are paying to the Bank of America headquarter, whether that will be subject to tax in India. So this explanation says that whatever the Indian branch is paying to its headquarter outside India or another branch outside India, that will be deemed to accrue rise in India. And therefore, the Indian branch has to deduct the TDS. And if the Indian branch does not deduct TDS, they will be liable for what? Assessee in default. That is what this section wants to tell us. I hope it is clear to all of you. So it's a very simple thing. This explanation is only for Indian branches of foreign bank. Citibank Indian branch, HSBC Indian branch, Barclays Indian branch, Bank of America Indian branch, Bank of Germany Indian branch, Abu Dhabi Bank Indian branch. It is only for Indian branch of foreign bank. Whatever loan they take from their head offices or other branches and interest they pay, that will also be subject to TDS. That is also subject to income which is deemed to accrue or rise in India as per explanation 9, and therefore TDS has to be deducted under section 195. I hope it is clear to all of you. Now, there are 3 sections over here one by one. That is 115AB, 115AC and 115AD. We will talk about all 3 of them one by one. We are not going to mix all of them together. First, we will talk about 115AB. Who is the assessee over here? The assessee over here is Overseas Financial Organization. Sir, who is Overseas Financial Organization? It's a non-resident who is outside India, who has taken an approval from SEBI to invest in India. So, where they are investing, sir? So, it's a non-resident association who has taken an approval from SEBI to invest in India. Where they are investing? Now, they are investing in UTI and they are investing in mutual fund but in foreign currency. So, what are they purchasing? They are purchasing UTI units, mutual fund units in foreign currency. So what is the tax? The dividend income will be subject to 10% and LTCG will be subject to 12.5%. Sir, if the mutual funds are equity oriented mutual funds, then will they get 1.25 lakh exemption? Always remember, in this section 1.25 lakh exemption is not allowed. I have told you in the class, you can write it down if you want. In this section 1.25 lakh exemption is not allowed. I hope it is clear to all of you. It is flat 12.5% for everybody, whether it is equity oriented or whether it is any other kind of mutual fund. Then whether we will get the deductions, no deductions are allowed. First proviso to 48 not applicable. What is first proviso to 48? That is TTBR, TTSR. You convert now first in foreign currency, then again into Indian currency in capital gains. All those things are not applicable to mutual fund. Those are applicable to bonds and shares of Indian companies. Second proviso, absolutely redundant. Second proviso is about indexation. Indexation is anyways not applicable after 23rd July 2024. Losses, if I have, can I set off? Yes, you can set off the losses against this income. What about exemption from ROI? No exemption from ROI. You have to file ROI always, always, always. Even if you only earn this income, still filing of ROI is mandatory. Great. Second, what is second section? 115AC. Who is the assessee over here? Non-resident and foreign company is the assessee. What are they buying? They are buying bonds of Indian company, bonds of public sector company and GDR. And all of them are in foreign currency. So always remember, if it is written that these bonds are notified under section 115AC, then you will come under this section. So 3 things you are buying. You are a non-resident and foreign company. You are buying bonds of Indian company notified by central government, bonds of PSU notified by central government and GDR notified by central government. All of them are in foreign currency. Long-term capital gains will be subject to 12.5%. Interest and dividend income on bonds, etc. will be subject to 10% tax. I hope it is clear to all of you. Rest all is same except the last point, which is different. Here you get an exemption from filing ROI. If you only earn interest and dividend income and TDS is deducted, there is no need to file income tax return. In first section, there is no such exemption. In first section, you have to file the income tax return always. In second section, if you only earn interest and dividend income and TDS is deducted, no need to file the income tax return. Third section. In third section, there are 2 assessees. First is FII. Second is specified fund, which we will see later on in the chapter of capital gains. So FIIs are covered and specified funds are covered. What are they buying? They are buying any security other than 115AB, and that too in any currency, not foreign currency, any currency. It can be foreign currency, it can be Indian currency, it can be any currency. Now, there are 4 different tax rates for capital gains and 2 tax rates for interest and dividend. Let's talk about interest and dividend first. FII, the interest and dividends will be taxed at 20%, and for specified fund, it is a lower rate, 10%. So for FII, it is 20%, and for specified fund, it is 10%. Whenever a question on FII will come now, always remember that is only 115 AD. Specific question will come, compute total income and tax of FII, then you have to follow 115 AD only. Interest will be taxable and dividend will be taxable at 20%. For specified fund, interest and dividend will be taxable at 10%. What about capital gains? Normal LTCG, 12.5%. Earlier it was 10%. 112 LTCG, 12.5% subject to 1.25 lakh exemption. Normal STCG, 30% flat. 111 STCG, 20% flat. So, normal LTCG, 12.5%. 112 LTCG, 12.5% subject to 1.25 lakh. Normal STCG, flat 30%. And 111 STCG, flat 20%. I hope it is clear to all of you. Rest all is same as the first section. Check it, please. Rest all is same as what? Same exactly like the first section, like this section. Now, here also there is one catch. You will get this benefit only to the extent the investors are non-resident. Only to that extent you will get the benefit. Suppose your interest income is 100 crore. Now you need to check out of the 100 crore income you have won in your fund, in your entity, how much are non-residents and how much are residents. So according to that, you have to find out the income. Suppose 100 crore into asset under management held by non-resident is what? 50 crore. And total asset under management is 150 crore. So therefore, only 50 divided by 150 will be subject to exemption. Full amount will not be subject to exemption. I hope it is clear to all of you, but this is not very important academically, I can say. This can be important practically. Academically, they only ask you question based on what? Just compute the income, that's it, and compute the tax. They don't tell you to do proportionately. I hope it is clear to all of you. So what is the meaning of this proportionately? This 12.5%, this 30%, this 20%, this 12.5%, this 20%, this 10% was only allowed to the extent the units are held by non-resident. If 100% units are held by non-resident, 100% incomes will be subject to this tax rate. If 70% units are held by non-residents, 70% income will be subject to this tax rate and 30% income will be subject to normal tax rate. I hope it is clear to all of you. Now, let's talk about taxation of global depository receipts, GDR. How GDRs are taxable under the income tax law. First of all, what is GDR? There is a company in India, for example, by the name called as Infosys Limited. First of all, Infosys Limited will go to UK, for example, to raise some funds. They will appoint one agent in UK, say a bank. Bank will work like an agent in UK. They will tell the bank that we want to raise money from outside India, that is, we want to raise money from non-residents in UK. So the bank in UK will issue GDR to the non-residents. Now, first of all, income tax law, under income tax law in 115AC only consider GDR of listed company. They don't recognize GDR of unlisted company. Therefore, in income tax law, GDR means only listed company GDR. Unlisted company GDRs are not covered. So there are three parties over here. One is listed company in India, Infosys. Second is foreign bank. Third is foreign investor. So the foreign bank has given the GDR to foreign investor and taken the money. Now, if that GDR is transferred by one NR to another NR outside India, if a GDR is transferred by one NR to another NR outside India, then it is exempt under section 47(7)(a). So if the listed company GDR is transferred by one NR to another NR outside India, that is exempt under section 47(7)(a). This is the first tax implication. Second tax implication. Suppose if that non-resident does not transfer the GDR but gives back the GDR to the Indian company and takes the shares in return. It tells the Indian company that I don't want GDR, take the GDR and give me the share. So he has to make a request of redemption to the Indian company. Suppose he makes a request to redemption of it to the Indian company that take the GDR and give me the share. So whatever is the fair market value on the date on which the request for redemption was made, that fair market value will become the full value of consideration. Of what? Of exchange, of transfer. Because see, if a non-resident is holding GDR and is giving GDR and taking share, that is also a transfer, that is subject to tax, that is not exempt under section 47(7)(a). What is exempt under 47(7)(a) is only transfer of GDR by one NR to another NR outside India. We are not transferring GDR by one NR to another NR outside India. We are giving GDR back to the company and taking shares. Therefore, the date on which request for redemption was made, that date FMV of share will be very important to take full value of consideration, and that will be the full value of consideration, and then you should reduce the cost of GDR to find out the capital gains. Now what does the investor has? Now the investor has what? The investor has now the shares of Infosys. Later on the shares of Infosys will be sold. Whatever is the selling price, that will become the FPC. What will be the cost? The cost will be again the FMV of the share on the date on which the request for redemption was made. Again, the date on which the request for redemption was made, that will become the FMV, that will become the cost of acquisition. The period of holding will also be counted from that day only to determine whether the shares are long term or short term. I hope it is clear to all of you. The period of holding will also be counted from the date on which the request for redemption was made. So everything revolves around the request for redemption was made, and in this example, the request for redemption was made on 15th September. So FMV on 15th September will be used to find out the capital gains on GDR, and that same FMV will become the cost of acquisition of the shares later on. And the period of holding will also be counted from 15th of September 2025 only. I hope it is clear to all of you. Let's move on to the next part, which is one of the most important provision of this chapter, that is the provisions of chapter 12A, special provision for non-resident Indians, which is given under section 115C2I. First of all, you need to understand certain definitions which are given in 115C. First of all, who is an NRI? An NRI is an individual who is a citizen of India or person of Indian origin, either of them, and who is a non-resident as per section 6 of Income Tax Act. So you need to be a human being, individual, you need to be citizen of India or person of Indian origin, and you should be non-resident as per the income tax law. What are they investing in? They are investing in specified assets. There are 4 types of assets which are covered in specified asset. Shares of Indian company, private or public, both are covered. First asset. Shares of Indian company, private and public, both are covered. Second, debentures of only public companies covered. Debentures of private company are not covered in 115C2I. Debentures of private company are not covered in chapter 12A. Deposits of public company are covered. Deposits of private company is not covered. And government security. Only shares of public and private both company are covered. Debentures and deposits are supposed to be only of public company, not of private company, and government security. All these assets must be purchased in foreign exchange. And from that asset, there has to be a long-term capital gains, or there has to be an investment income in the form of interest and dividend. Then you are covered under this section. Now, against all these incomes, will you get any deduction? No deduction under section 28 to 44C, no PGBP deduction, no IFOS deduction, no chapter 6 deduction, nothing will be allowed. Only first proviso to 48 will be applicable against bonds and against debentures and against shares. Okay, only first proviso to 48 will be available against shares and debentures. Now, first proviso, that is you have to convert that TTB or TTSR, you have to do that. Okay, other incomes will be taxed at normal rate. What is the tax rate, sir? Remember, only LTCG is covered and only interest and dividend income is covered. Interest and dividend income will be subject to 20% tax, and LTCG will be subject to 12.5% tax. All LTCGs are subject to 12.5% tax. Even 112A LTCG will be subject to flat 12.5% tax without exemption of 1.25 lakhs. Here also 1.25 lakh exemption is not allowed, and in first section 115AB also 1.25 lakh exemption is not allowed, but in 115AD, remember, 1.25 lakh exemption is allowed. I hope it is clear to all of you. Now, what about other incomes? Other incomes will be taxed at normal rate. So, interest and dividend 20%, LTCG 12.5% without 1.25 lakh exemption, interest and dividend 20%, other incomes normal rates. Now, one of the biggest advantage of coming into this section is section 115F. What is 115F? If you have a long-term capital gains today and within 6 months from the date of transfer, if you invest the net consideration again in the specified assets, then your entire non-long-term capital gains will be exempt. But if you don't invest the full net consideration, then proportionate capital gains will be exempt. So if you invest the full net consideration, then full capital gains will be exempt. Where you have to invest? You have to invest the net consideration within 6 months from the date of transfer in again specified assets. Within how many months? Within 6 months. Where? In 4 specified assets, which I have told you at the beginning in 115C. If you don't invest full net consideration, then proportionate exemption will be allowed. Then there is a lock-in period here also. You have to retain this new investment for a period of 3 years. If you sell within 3 years, then whatever capital gains was exempt earlier, that will be deemed income, and also the new capital gains will also be subject to tax. Are we going to get some exemption from filing ROI? Yes. If you only earn interest income or dividend income or long-term capital gains income and your TDS is deducted, there is no need to file any ROI. Only interest income, only dividend income and TDS is deducted, then there is no need to file any ROI. Sir, today I am non-resident. What if I become resident in subsequent year? Don't worry, this chapter will continue to apply to you till the time you do not redeem your debentures or deposits or don't sell your shares. So till the time you do not redeem your debentures, do not sell your shares, do not deposit, do not redeem your deposit, do not sell your government security, this chapter will continue to apply to you. And last but not least, this chapter is optional. It is not a mandatory chapter for you. If you want to take, you can take it by filing the income tax return. At that time, you have to opt it. If you don't want to take it, don't take it. I hope it is clear to all of you. Let's go on to the next part, and the next part in this chapter is with respect to exemptions under section 10 for non-resident. So now we are going to see all the exemptions of section 10 which are for non-residents only. Like otherwise there are more than 50 clauses in section 10 which is for all different kind of associates, but today we are only interested in exemptions which are applicable to non-residents. The very first exemption is for certain foreign companies who are engaged in exploration of oil and selling of crude oil. So first exemption that we are going to see over here is section 1048, then 1048A, B and 1048B once again. Now remember 1048 is a separate section and 1048A, 1048B and these three sections are related to each other. First one has nothing to do with the next three ones and the next three ones are related to each other. Let's talk about the first one. When is the first exemption applicable? The assessee is a foreign company. The assessee is engaged in sale of crude oil or other goods and services which are notified by central government. As of now, no other goods are notified by central government. They are selling this crude oil to any person in India, resident or non-resident doesn't matter. They will receive money in India. They will receive money in Indian currency. They will not get engaged in any other activity. They will have an agreement with central government and there is a national interest in that. If all these conditions are fulfilled, then the sale of crude oil to any person in India will not be subject to tax in the hands of the foreign company. What is 1048B then? 1048B is slightly stricter. Here also foreign company is there. Here also crude oil is there. But here you have to store the crude oil and then sell it. In first section, you don't have to store the crude oil. You can directly sell from outside India. Second important thing. In second section, in 1048A, there is only crude oil mentioned. Other goods and services notified is not mentioned here. Third important thing, in this section, the income has to get accrued in India. It may not be received in India. It may not be received in INR. It doesn't matter if it is received outside India. It doesn't matter if it is received other than INR. It's okay. Fourth difference. One more difference. Here you have to sell the crude oil to person resident in India. Here you have to sell it to any person in India. But here you have to sell only to Indian residents. Next difference. Here in first section, you should not be engaged in any other activity. Here you can get engaged in any other activity also. That's okay. Last but not least, this point is similar to both the section. It is there in the first section also. It is there in the second section also. Now, the third and the fourth section is an extension of the second section. Third and the fourth section has nothing to do with the first section. The third and the fourth section has to do great amount of linking with the second section. Now, there is an agreement between the foreign company and the central government that they will store crude oil in India for 5 years and then they will sell. Suppose after 5 years the agreement expires and then there is some leftover stock in the storage hub. So what will happen with that leftover stock? That leftover stock after the expiry of the agreement will also be exempt as per section 1048B. I hope it is clear. So whatever stock will be left over after the expiry of the agreement, that will also be exempt under section 1048B. Now, suppose the agreement is for 5 years and if the agreement gets terminated within 2 years, foreign company doesn't want to continue in India, so they are terminating the agreement, or Indian government has terminated the agreement. In that case, what will happen with the leftover stock? So whatever is the leftover stock after termination of agreement, that is also exempt under section 1048B. So both the cases it is exempt. If the leftover stock is sold after expiry or if the leftover stock is sold after termination, both are exempt under section 1048B. I hope it is clear to all of you. Now, 1048E we will talk about. What is exempt under this section? There are a lot of small things that you have to keep it in mind. So now, first of all, the income is earned by non-resident. How the income is earned by non-resident? By transfer of non-deliverable forward contract, first instrument, offshore derivative instrument, second instrument, over the counter derivative, third instrument. And what is the nature of income? They are transferring, therefore the nature of income is capital gains. Second income which is getting exempt is distribution of income of offshore derivative instrument and over the counter derivative. Now they are entering into this contract with whom? They are entering into this contract with an offshore banking unit of an IFSC referred in ATLA, or they are entering into this contract with foreign portfolio investors being a unit of IFSC which fulfills some conditions as may be prescribed. What is the condition? That is the offshore banking unit should have a valid certificate registration under IFSC regulation. So again I am saying, who is the assessee? Non-resident is the assessee. What is the non-resident doing? They is earning some capital gains from transfer of non-deliverable forward contract, offshore derivative instrument over the counter derivative, and he is also earning some income from offshore derivative instrument over the counter derivative. They are entering into this instrument with whom? With an offshore banking unit of IFSC or with a foreign portfolio investor who is fulfilling certain conditions. What conditions they have to fulfill? They have to hold a valid certificate under IFSC regulation. Okay, I hope it is clear to all of you. Next exemption, section 10(4)(f). Again, the income is earned by non-resident. What income? The non-resident is earning royalty or interest. How? By leasing aircraft or a ship. To whom? So they are leasing to a unit of IFSC, which is paid by a unit of IFSC. So non-resident is leasing aircraft, or the non-resident is leasing ship to a unit of IFSC, and the unit of IFSC is paying them what? Paying them royalty and paying them interest. That royalty and interest is subject to deduction under ATLA in the hands of the non-resident. Therefore, this will not be subject to what? This will not be subject to tax. I hope it is clear to all of you. Third exemption under section 10(4)(g). Again, the income is earned by non-resident. I told you we are only interested in exemptions of non-resident. We are not interested in exemptions of other assessee today. So what is the non-resident doing here? The non-resident is having some portfolio of security or financial product which is managed by a portfolio manager. And where is that portfolio manager? That portfolio manager is also located in IFSC. That portfolio manager is located in IFSC. So 10(4)(g) covers what? There is a non-resident outside India and there is a portfolio manager in India. That portfolio manager is managing the portfolio of non-resident, and he is buying, selling the shares. Then that will not be subject to tax in India, provided the buying and selling should not happen in India. It should happen outside India. The buying and selling should not happen in BSE or NSE. The buying and selling of the shares by the portfolio manager in India on behalf of the non-resident should happen in NASDAQ or New York Stock Exchange or Dow Jones or Japan Stock Exchange. It should happen outside India. It should not happen in India. I hope it is clear to all of you. Next one is section 10(4)(h). In 10(4)(h), some conditions have to be fulfilled. There is a non-resident. Assessee number 1 is a non-resident. Assessee number 2, unit of IFSC, engaged primarily in the business of leasing of aircraft or ship. So there are two assessee. Assessee number 1 is a non-resident. Assessee number 2 is a unit of IFSC which is engaged in the business of leasing of aircraft and a ship. What are they doing? They are transferring shares, equity shares of a domestic company engaged primarily in the business of leasing of aircraft or ship. So this assessee is transferring the shares, equity shares of a company which is engaged in leasing of aircraft or leasing of a ship, and whatever capital gains they are earning, that will be exempt for a period of 10 years. For 10 years, the capital gains is exempt. I hope it is clear to all of you. Next one, I will talk along with capital gains, because for that you need to know the definition of specified fund. I can just say that here the capital gains is exempt by non-resident and specified fund when they transfer the shares of a company resident in India. So therefore, in that case, capital gains is exempt. Now the next one is a very important exemption under section 10(6). This exemption is only available to individuals who are not citizen of India. So individuals who are not citizen of India, who are working in US Embassy in India, UK Embassy in India, their remuneration is what? Exempt over here, provided two conditions are fulfilled. Condition number one is our corresponding government employees should also be exempt in their country. If you exempt our employees, we will exempt your employees. For example, in India, US Embassy is there, and in US, Indian Embassy is there. In India, US Embassy, US citizens might be working, and in US, Indian Embassy, Indian citizens might be working. We will exempt the remuneration of your citizen, provided you also exempt the remuneration of our citizens in United States. Then only we will exempt. Second condition, that non-resident, that employee should not be engaged in any other business and profession or employment in India. That employee who is working in what? US Embassy in India, he should not be engaged in any other business or profession or employment in India. I hope it is clear to all of you. So again, who is the assessee? The assessee is a not citizen of India. The assessee is a foreign citizen working in some foreign embassy which is located in India. They are receiving some remuneration, that is exempt, provided our remuneration of our employee should also be exempt, and that employee who is working in US Embassy in India, he should not be engaged in any other business, any other profession or any other employment in India. Next one I have given you example in the class. Tesla is sending employees in India. So there is a foreign enterprise who does not have any business and trade in India. He is sending their employees in India for some license office in India purpose. Up to 90 days they are staying in India, and whatever remuneration is paid by Tesla to their employees in India, they are not taking deduction of that under the income tax law. So if the Tesla does not have any business and profession in India, they are sending their employees to India up to 90 days, and their employees remuneration is not subject to deduction in India, then the remuneration paid by Tesla to its foreign national, again the assessee has to be foreign national. It should not be an Indian citizen. In this section and in previous section, the assessee, the employee has to be foreign citizen. It should not be Indian citizen. If it is an Indian citizen, then it is taxable in India. I hope it is clear to all of you. Now let's go ahead with one last exemption, that is under section 1023 FE, which is the biggest exemption of non-resident taxation. Here the government is giving exemption to certain specified person. There are 3 persons which are considered to be specified person, and some incomes of specified persons are not subject to tax. Let's first understand who are these specified persons. The first specified person is wholly owned subsidiary of Abu Dhabi Investment Authority, which is a resident of UAE, makes investment directly or indirectly out of the funds owned by the government of Abu Dhabi. Now, so there is a government of Abu Dhabi. Under that government of Abu Dhabi, there is an entity by the name called as Abu Dhabi Investment Authority, and of that Abu Dhabi Investment Authority, there is a wholly owned subsidiary. That wholly owned subsidiary is a specified person for the purpose of this section. Okay. So Abu Dhabi government, below that there is an Abu Dhabi Investment Authority, and there is a subsidiary of that, and that subsidiary is a specified person for the purpose of this section. Second is a sovereign wealth fund which fulfills around 5 to 6 conditions. First condition, the sovereign wealth fund is owned by the government of foreign country. It is set up and regulated by the foreign country. Its earnings are only credited to the government of foreign country and to any other account which is designated by government. It means they are not passing benefit to any private person. So whatever earning is earned by that particular entity, whatever earning is earned by that particular sovereign wealth fund, entire earning will be given to the government or any account which is designated by the government. Further, on dissolution, all the assets will also go to government. But condition number 3 and 4 will not be applicable in some cases where they have to make payment to creditors, or where they have to make repayment of loans to the depositors. So if you have taken something on credit from some creditor, then you have to obviously give your earning to them. If you have taken a loan from someone, then you have to obviously repay the loan to them also. Okay. Condition number 5, they do not participate into the day-to-day operations of the investee. The sovereign wealth fund will not interfere into the day-to-day operations of the investee. Yes, but to protect the investment, which billions of dollars they have made, they have the right to protect the investment, and they have the right to appoint directors, they have the right to appoint executive directors. This shall not amount to what? Day-to-day participation into day-to-day operations in the investee. So by default, the sovereign wealth fund will not interfere into the day-to-day investments, day-to-day operations of the investee, but to protect their investment, they can definitely appoint the directors, they can definitely look into the executive director's appointment, etc. That will not be considered as what? Participation in day-to-day operations. Now, last but not least, the government will notify, the central government will notify such sovereign wealth fund, and only then the exemption will start. Third category of person is pension fund. This pension fund is also created under the law of foreign country. Under foreign country it is created. This is not liable to tax in the foreign country. This pension fund should not be liable to tax in the foreign country. This pension fund should fulfill such other conditions as may be prescribed. And condition number 4 and 5 is similar to the previous case. You can check it. This one and this fourth and fifth condition is exactly similar to the sovereign wealth fund. If all these conditions are fulfilled, these are the 3 specified persons. I will again sum up. First is wholly owned subsidiary of Abu Dhabi Investment Authority. Second one is sovereign wealth fund who fulfill 6 conditions. Third one is pension fund who fulfill 5 conditions. Which income is exempt? Their dividend income will be exempt, their interest income will be exempt, and their business trust income will be exempt, which is covered under 56(2)(12). What is covered in 56(2)(12)? 56(2)(12) covers the debt repayment by business trust to its investor. So whatever is a debt repayment by the business trust to its investor, that is covered and taxable under 56(2)(12). So that is also exempt. Dividend is exempt, interest is exempt, debt repayment by business trust to the investor is exempt, and LTCG is exempt, whether or not it is covered under 50AA. Even if it is a 50AA investment like unlisted bonds, unlisted debentures, in that case also, remember 50AA says that some assets are always short term, but these assets, if they are short term, then they will not be subject to exemption. But if the unlisted bond, unlisted debenture, market linked debentures, yes, or specified mutual fund, these are long term, then they will be subject to exemption in this particular section. I hope it is clear to all of you. Where are they investing? They are investing in debt, they are investing share capital, they are investing in unit. Once again, I am saying, because this is the first point, number 1 is the most important point. Dividend is exempt, interest is exempt, debt repayment by business trust is exempt, and LTCG is exempt. Even if the LTCG is covered in 50AA, 50AA says that 4 assets are always short term, but if those 4 assets are held for more than 24 months, then they can become long term for the purpose of this section. For the purpose of this section, in short, you can say 50AA is not applicable. Okay. Now, when the investment should be made? The investment should be made between 2020 to 2030. The investment should be held for at least 3 years. The lock-in period is at least 3 years. If you sell within 3 years, then whatever capital gains and dividends exempt, interest is exempt, that will be subject to tax. That is mentioned later on. Now, pay attention, please. Where they should invest? They should invest in 5 entities. First, in business trust. Second, they should invest in a company or enterprise which is engaged in any infrastructure facility. Third, they should invest in AIF, category 1, category 2, which invest not less than 50% in category B company, category D company, and category E company. Then they should invest in a domestic company which is just started in 2021, which invests 75% of their money in category B company. And they should invest in an NBFC which lend 90% to category B company. So they should invest in these 5 companies. First is in business trust, second in infrastructure company, third in category 1, category 2 AIF who invest at least 50% in B, D and E. Point number D, who invest at least 75% in B company. Point number E, who invest at least, who give loans of at least 90% to B company. If you invest in any of the 5, you will be subject to what? Exemption. Now, there is some condition which you have to further fulfill for point number C, D and E. See, for point number C, if you invest 50% in B, D and E, then you are eligible for exemption. So suppose you invest 60%, then you are eligible, but only 60% dividend, interest, capital gains will be exempt. If you want 100% exemption, then entire 100% should be invested in B, D and E. Similarly, for point number D, what is the criteria for exemption? 75%. If you invest 75%, then you are eligible for exemption. But then in that case, only 75% will be exempt. If you want to exempt entire 100%, then entire 100% should be invested in what? Category B company. Similarly, for here, 90% is the criteria for exemption. If you want entire 100% to be exempt, then you have to invest entire 100, then you have to give loan of entire 100% money to category B company. Then only you will be eligible for exemption. I hope it is clear to all of you. This is what it is written over here. Now let's move on to the next section, which is one of the most important section once again, 115 BBA, which is for non-resident sportsmen who are non-resident and also not a citizen of India. They are foreign citizen and they are non-resident. What are they doing? They are coming to India to play any game or any sport in India, or they are coming to India and doing advertisement. They are contributing in any articles relating to sport or game in India in newspaper, magazine, journal, etc. So whatever money they earn by playing the game or sport or advertisement money or contribution in contribution of article in any in relation to any game or sport in any newspaper, journal, magazine, all of them will be subject to 20% tax flat, subject to surcharge if applicable and cess. Tax will be under 115 BBA and TDS will be deducted under 194E. For the non-resident sports associations will also be subject to tax. All the non-resident sports association, now this year World Cup 2026 T20 World Cup, 2020 World Cup is in India, and therefore whatever BCCI is paying to all the non-resident sports association, that will also be subject to tax here in India under section 115 BBA, and TDS will be deducted under 194E. Similarly, if an entertainer is coming to India who is not a citizen of India and who is a non-resident, entertainer also who is a non-resident, who is not a citizen of India, is coming to India for the purpose of entertainment, music, dance, etc. From the performance of India, whatever income they earn, that will also be subject to 20% tax flat. Whether they will get any deduction of any expense or allowance, no deduction of any expense or allowance. Are they liable to file the income tax return? They are not liable to file income tax return if they earn only this income and TDS is deducted. Whether umpires and referees are also covered? No. Umpire and referees are not sportsmen. They are not covered. If the umpires and referees are resident, then their TDS will be deducted under 194J. If they are non-resident, then their TDS will be deducted under 195. Umpire and referees are not covered in 194E and 115 BBA. Only sports persons are covered and only entertainers are covered. I hope it is clear to all of you. Let's move on to the next section. Next section is again a very unique section, not asked much in the examination, not very important, 115JG. Let me give you a background of this section also. I have to give background of each and everything which I have given you in class in great detail. Suppose there is a Bank of Germany outside India and there is a branch of Bank of Germany in India. Now they want to convert that branch into an Indian subsidiary. So a lot of questions will be asked. Can they convert that Indian branch into an Indian subsidiary? The answer is yes. So what about all the assets they will transfer, whether capital gains will be charged? The answer is no. No capital gains will be charged. What about the losses and UAD? Will they be allowed to carry for the losses and UAD? The answer is yes. You are allowed to carry for the losses and UAD. What about the MAT credit if they have? They are allowed to carry for the MAT credit? Yes. The MAT credit can also be allowed. Further, the CBDT has given a notification which you have to fulfill. If you fulfill this notification, then you will be eligible for all these exemption. And in this notification, they have given a lot of other things. What about current year depreciation? When the conversion is happening, suppose the conversion from Indian branch to Indian subsidiary is happening on 1st October. So what will happen to the current year depreciation? Current year depreciation shall be apportioned between both of them. What about the set off of losses? set off of losses, PGBP losses other than speculative losses, only section 72 losses can be carried forward for another 8 years. This is the only exception in the entire income tax law where you can carry forward the losses for another 8 years. Rest all places under the entire income tax law, in case of amalgamation, demerger, succession, everywhere you have to carry forward the losses for balance number of years, not another 8 years. This is the only exception where it is allowed to carry forward for another 8 years, and for UID there is no time limit. What about the WDV of the asset? The WDV of the branch will become the WDV in the hands of the Indian subsidiary, and Indian subsidiary can put in the block and claim depreciation. What about the cost of acquisition of other asset? The cost of acquisition in the hands of the Indian branch will become the cost of acquisition in the hands of the hands of the Indian subsidiary. Period of holding, the period of holding will be clubbed. What about the MAT credit? The MAT credit of the Indian branch will be carried forward by the Indian subsidiary, and it will be carried forward for another 15 years, fresh 15 years period. What about VRS expenses? VRS expenses are generally allowed over a period of 5 years. So remaining period will be allowed to the subsidiary. So if 2 years have already over, so remaining 3 years subsidiary can claim the benefit. What about provision for bad debt? Provision for bad debt. See, what happens generally, provision for bad debts, you compare your actual bad debts with provision for bad debts. When you compare your actual bad debts with provision for bad debts in case of banking industry, because this is a bank, and when you compare your actual bad debts with provision for bad debts, you compare with your actual bad debts with current year provision and opening provision. So when you compare the current year provision and opening provision, will you take the opening provision of Indian branch also? The answer is yes. The opening provision of Indian branch should also be taken over here. I hope it is clear. Last but not least, how the things will be exchanged. There is a branch in India. There is a parent company outside India. The parent company will convert the branch into a subsidiary. So the subsidiary will give shares to parent company. So whatever shares are given to parent company, whether gift taxation will apply in the hands of the foreign company, no 56(2)(10) shall apply in the hands of the foreign company for receiving the share. Because the foreign company will receive shares now from the Indian subsidiary. Then only the subsidiary can come now. If you have to make a subsidiary in India, there has to be some parent outside India. And last but not least, you should not violate any condition in future. Suppose after 3-4 years in 2029, if you violate any conditions of the central government notification while conversion, then whatever exemptions etc. you have claimed, all will be reversed, and it will be reversed within 4 years from the end of the financial year in which you violate the condition. So in whichever year you will violate the condition, in my example I am violating the condition on 31st March 2029. So within 4 years from the end of 31st March 2029, the assessing officer will add back all the exemptions, will disallow all the losses which I have set off, will disallow all the UAD which I have set off. I hope it is clear to all of you. So this is what this provision is all about, not very important for exam. So let's go ahead with the next part, which is a very important part for your examination, that is presumptive income for non-resident taxation. The very first presumptive income for non-resident taxation is with respect to shipping business of non-resident other than cruise shipping. For cruise shipping, the Government of India in last year Finance Act 2024 has made a separate section 44 BBC. So this section does not cover cruise shipping, it covers all other kinds of non-resident shipping business. Okay. Now in this case, what happens? You have to apply two sections. First, you have to apply section 172, and then you have to apply 44B in the assessment year. 172 will be applied in the previous year when the ship has come to India and left India, and 44B will be applied in the assessment year. Now, what is 172? Let's talk about 172 now. Suppose a ship from Singapore, a non-resident owning a ship from Singapore is coming to India. In Bombay, he is coming from, in Mumbai, he is coming, and he is leaving the ship from Mumbai. While leaving the ship from Mumbai, he is carrying passenger, he is carrying livestock, he is carrying mails, he is carrying goods, and he has earned 1 crore rupees. He has earned a revenue of 1 crore rupees, which will also include demurrage charge and handling charges also. When you take the deemed income, you should also include demurrage charge and handling charge in the deemed income. So whenever he will leave the ship from India, section 172 says that as soon as the ship will leave, at that time only he has to pay tax. How much tax? What is the deemed income? Section 172 will say everything. Section 172 put charge on tax on your income when the ship is leaving India. So whenever the ship is leaving India, at that time only you have to pay the tax. What will be the deemed income? Whatever money you have received, including demurrage charge and handling charges, 7.5%, 7.5% of that amount will be your deemed income. Secondly, what will be the tax? Tax will be as per foreign company. What is the tax for foreign company? 35% plus surcharge if applicable and cess. Will I get any deduction of any expense? No deduction of any expense. Will I get any chapter 6A deduction? No deduction of chapter 6A. No deduction of set off and carry forward of losses. Whenever a foreign company or a non-resident comes to India and leaves India, whatever money they have earned, 7.5% will be deemed income, 35% will be tax subject to surcharge and cess. No deduction of any kind. No PGBP expense, no set off and carry forward of losses, no chapter 6A. Nothing will be allowed to you. Nothing. Just pay tax and go ahead. That's it. Sir, is this not injustice? There is no injustice in this. There is nothing injustice in this. All these things will be done in the previous year. If you feel it is injustice, you can come in the next year under 44B. Under 44B, you can show all these incomes again. Again, your deemed income will be 7.5%. But again, you will not get the deduction of PGBP expense because 44B overrides section 28 to 43. You will not get PGBP expense. But you can get now in 44B what? Two deductions. That is set off and carry forward of losses. If there are some losses which are assessable to tax in India, you can set off against this income now. And you can also take chapter 6A. Plus one more benefit, you will also get the benefit of your actual slab rates now. You don't have to pay tax as per 35%. If you're an individual, pay tax as per individual slab rates, old regime, new regime, whatever is more beneficial for you. And whatever amount you have paid under 172 earlier, that will be allowed you as the advance tax as per Supreme Court judgment of A.S. Glitter, and you will be refunded your amount along with the interest. So amount paid under section 172 will be treated as advance tax. So what is 172? 172 only covers one income when the ship leaves India. What if the ship leaves from Singapore and goes to Dubai, or leaves from Dubai goes to Singapore, and the money is received in India? That item is not covered in 172. That item has to be mandatorily covered in section 44B only. This is not covered in 172. This has to be covered in 44B. 44B only, 172 only covers that income where the ship is leaving India. If the ship is leaving some other country, then that income will be or directly charged in the assessment year under 44B. I hope it is clear to all of you. Now, in 172, when I am making some payment to someone, am I supposed to deduct TDS under 195? No need to deduct TDS under 195 because 172 overrides the entire income tax law. Now, because it overrides the entire income tax law, it will also override section 195, and therefore there is no need to deduct TDS under 195 if you are liable to pay tax as per section 172. So again, I am saying 172 covers one income which is common in 44B also. 44B covers two income. One income is common to 172. One income is absolutely new, which is not covered in 172. Now let's see the distinction between also. 44B is the charging section, whereas 172 is a recovery mechanism. 44B covers two incomes. One which is shipped at any port in India, which is covered in 172 also. Second income which is shipped at any port outside India, which is not covered in 172. I hope it is clear to all of you. 44B taxes at normal rates. 172 taxes at 35% plus surcharge and cess if applicable. 44B overrides section 28 to 43 only. Only PGBP is overridden in 44B. But in 172, sorry, in 172, entire income tax is overridden. 44B, because it overrides only 28 to 43, therefore losses and chapter 6A you can claim. Because 172 overrides the entire income tax act, even losses in chapter 6A you cannot claim. I hope it is clear to all of you. This is what this beautiful section is all about. Let's go ahead with next section, that is 44BBA, that is non-resident aircraft business. Now, if an aircraft business is owned by a non-resident, how the income will be subject to tax? Very simple. If the aircraft is leaving India, it will be subject to tax. If the aircraft is leaving some other country, but it is money is received in India, then also it is subject to tax. There are two cases in which it is taxable. If the aircraft is leaving India, then it is definitely subject to tax. If the aircraft is leaving some other country, then it is taxable. If the money is received in India, the deemed income is how much? The deemed income is only 5%. That's it. This section also overrides section 28 to 43. Therefore, no PGBP expenses will be allowed. Yes, set off of losses you can claim, and chapter 6A also you can claim. There is no concept of 172 over here. Directly you have to pay tax as per 44 BBA. 172 concept is only for shipping business. It is not for what? It is not for aircraft business. I hope it is clear to all of you. Third section, 44 triple B. Now this section, be very careful, is only applicable to foreign company. The previous two sections were applicable to all kind of non-resident. But this section is only applicable to foreign company, foreign company and foreign company. What is the foreign company doing over here? The foreign company is engaged in civil construction. Either it is engaged in construction or erection of plant and machinery, testing or commissioning as a turnkey project. So if a foreign company is coming to India, doing construction, doing erection of plant and machinery, doing testing, commissioning as a turnkey project. Turnkey project, I have told you in the class, a project which is complete in every sense. A project which is complete in every sense is called as a turnkey project. In this case, the deemed income will be 10%. Again, it overrides section 28 to 44. Because it overrides section 28 to 44, no PGBP expense will be allowed. You can claim set off of losses. You can claim chapter 6A. I hope it is clear to all of you. Now, in this section, unlike the previous two sections, you have an option to show lower profits. If you feel that your actual income is less than 10%, then you can maintain books of accounts and conduct tax audit and show lower profit also. This option was not available in the previous two sections, that is in 44B for shipping business and 44BBA for airline business. These two businesses did not have this option, but this business, the third business, has this option. Let's go to the fourth deemed income. The fourth deemed income is 44BB. Again, now here it is non-resident, not foreign company. Foreign company is covered only in one section, that is 44BBB. What is this SSC doing? This SSC is providing services or facilities, or it is also supplying plant and machinery on hire. So it is doing three things. It is providing some services to us, it is providing some facilities to us, or it is giving plant and machinery on hire. For what purpose? For prospecting, extraction or production of mineral oil. So if a non-resident is providing these services or these facilities, or it is also giving plant and machinery on hire for extraction or production of mineral oil or prospecting of mineral oil, then in that case the deemed income will be 10%. Okay. Here also, if you feel that your actual profit is lower, you have an option to show lower profit by maintaining books of accounts, by conducting tax audit under 44AB. Maintain books of accounts as per 44AA and conduct tax audit as per 44AB. I hope it is clear to all of you. Now there is one issue which came in front of us. Suppose this services or this facility which is providing to us, the non-resident is providing services to us, the non-resident is providing facilities to us. Suppose the service and the facility which is providing to us, suppose that service and facility is in the nature of FTS, fees for technical service, then whether should I come here or should I go to 115A and 44DA? So the law has clarified that if it is FTS, then you should go to 115A and 44DA and you should not come to 44BBB. I hope it is 44BB. So if the service and the facility is of technical nature, FTS, which is specifically covered in section 917, then you should go to 115A and 44DA. Don't come in this section. I hope it is clear to all of you. Now, in all these sections, can the assessing officer increase my income from 7.5% to 10%, 5% to 10%, 10% to 15%? The answer is no. In these sections, the assessing officer does not have the power to increase the income. But yes, in 44AD, 44ADA, 44AE, the assessing officer has the power to increase the income, because in 44AD, ADA and AE, what was written? Deemed income or such higher income as claimed to have been earned by the assessee. But in this non-resident section, non-resident chapter, it is not written like this, or such higher income is not written in this chapter. Therefore, they are not liable to, the assessing officer cannot increase the income beyond the percentage which is mentioned over here. Now, next is the relaxation is in MAT. Suppose a foreign company is only earning income under 44B, 44BB, 44BBA and 44BBB. So if a foreign company is earning only these incomes, then they are not liable for MAT. The foreign company will not be liable to MAT if they are earning only these income, no other incomes are earned, only these presumptive incomes are earned, then the provisions of MAT are not applicable to them. And last but not least, for the last two sections which we have done just now, that is the civil construction section and the exploration of mineral oil section, in these two sections you will not get UAD deduction and brought forward losses deduction. UAD deduction and brought forward losses deduction will not be allowed to you in the last two sections. Okay, I hope it is clear to all of you. Now let's go to the next section, that is 44BBC, which is non-resident cruise business. Here we have to do two things. 44BBC is also there, and there is rule 6G is there, 6GB, and there is section 1015B. These are the three things which we need to learn together to understand this concept of cruise business. First of all, if you are a non-resident, engage in the business of cruise ship, your deemed income will be subject to 20% of your amount payable. Whatever amount you will get, of that 20% will be deemed income, subject to some conditions which the law has prescribed. The law has prescribed where? In rule 6GB. First of all, if the non-resident is engaged in the business of operation of cruise ships, their deemed income will be how much? 20%. Okay. Here also, it overrides section 28 to 43. Therefore, no PGBP deductions, no PGBP expense or disallowances will be applicable in your case. Now, the first thing which I have told you is very clear. Non-resident engaged in the business of operation of cruise ships will be subject to 20% deemed income. Now, this is subject to some prescribed condition. What are the prescribed conditions? First prescribed condition is the non-resident operate a passenger ship which is having a carrying capacity of more than 200 passengers. How many passengers should be there in the, how many passengers capacity should be there in the ship? More than 200 passengers. Or the length should be how much? 75 meters or more. So either of the two conditions has to be fulfilled. Either the capacity should be 200% or the length of the ship should be 75 meters or more. And it should be for leisure purpose, recreational purpose. It should have dining and cabin facilities for passengers. Cabin means it should have proper bed facility, etc. for the purpose of staying in the ship. So this is the first condition which you have to fulfill. Second, it should work on a scheduled voyage or shore excursion touching at least 2 seaports of India and same seaports of India twice. So it should work within India only. It should be for a scheduled voyage, that it is leaving on 15th, coming back on 20th. There has to be a proper schedule. It should also include a shore excursion where they will tell you to go down, explore the area and come back to the ship. All these things should happen, and it should at least touch 2 seaports in India. Third condition, it should be primarily for carrying passengers and not for cargo. It should not be for cargo, and it should work as per the Ministry of Tourism and Ministry of Shipping. So it should work as per the Ministry of Tourism and Shipping, and it should work as per the government guidelines, in short. Okay. Now, there is one exemption also which is over here. To explain this exemption, we need to understand 3 parties. One is specified company. Specified company is a company which is other than a domestic company and following 44 BBC. Specified company is other than domestic company and following 44 BBC. Okay. Now, there is one foreign company over here, and there is one parent which is parent to common to both of them. That is, the parent is common for specified company also it is a parent, and for this foreign company also it is parent. Now, pay attention please. Now, if this specified company, okay, is getting some rental, any income of foreign company from lease rental received from specified company. So who is giving rental to whom? Specified company is giving rental to foreign company. So try to understand there are 3 parties. Again I am saying specified companies other than domestic company who follows 44 BBC. There is a foreign company and there is a parent. Now this foreign company is leasing ships to specified company and they are paying rental to foreign company. This rental earned by the foreign company is exempt under section 1015B. Check please. This rental which is earned from specified company and for which there is a common parent. Therefore, this rental earned by the foreign company is exempt under the income tax law. I hope it is clear to all of you. Let's go ahead with the next section, which is absolutely a new section, 44 BBD, introduced by Finance Act 2025. What is this section all about? This applies again to non-resident. What is the non-resident doing? Non-resident is providing some services. First thing, non-resident is providing services or technology. They are providing either services or technology for setting up a electronic manufacturing facility in India or producing electronic goods in India. So non-resident is providing some services, some technology for setting up some electronic manufacturing facility or producing electronic goods in India. So whatever they are providing these services to whom? They are providing these services to resident company engaged in electronic manufacturing, and this scheme is notified by whom? It is notified by Ministry of Electronics and Information Technology. So who is the service provider? Non-resident. Who is the service receiver? Resident company. What service they are giving? They are providing services or technology for manufacturing of electronic facility or producing electronic goods. What will be deemed income? The deemed income will be 25%. Whatever they will earn, 25% will be deemed income. Okay. Now, whether they will get any PGBP deductions? No PGBP deductions, no PGBP disallowances will be applicable because again section 28 to 43A is overridden. Now, whether they will get UID deduction? Even UID deduction is not allowed. Even brought forward losses deduction is also not allowed under this section. Now, again a question is arising. What if the service they are providing is a FTS service? Just like 44BB, in 44BB also same issue was arise. What if the service provided is 44, what if the service which they are providing, it is not a normal service, but it is in the nature of FTS. So here what it is said, even if it is a FTS service now, then also it will come in this section only. It will not come in 44DA and 41115A. In 44BB it was different. Remember, in 44BB what was written? If it is an FTS service, then go to 115A and 44DA. Here it is written, provisions of 44DA and 115A do not apply to these amounts. Therefore, here even if it is an FTS, then also you have to consider this as a section 44 BBD income only, not as 115A and 44 DA. I hope it is clear to all of you. So this is what this section is all about. Now next section is extremely important. 44C, a non-resident is outside India. They have a branch in India. Now they are allocating head office expenses in India. So how much head office expense they can claim in India? So that will be allowed subject to the following lower of the two. First, actual head office expense attributable to Indian branch. Whatever is the actual head office expense they have attributed to Indian branch, compare with 5% of the adjusted total income, whichever is lower. So 5% of the adjusted total income compare with actual expense allocated to India, whichever is lower. Sir, what is adjusted total income? Adjusted total income is nothing but your total income, but after adding the following items. Add the following items to the total income. First, add UAD, add brought forward losses, add capital expenditure of family planning, add chapter 6A, and add actual head office expense debited to P&L. Add back all these items. Once you add back all these items, you will get adjusted total income. Take 5% of that. 5% of that will become what? Become point number 1. So what if the adjusted total income is negative? If adjusted total income is negative, then you have to take 5% of the average adjusted total income. Sir, what is average adjusted total income? Average adjusted total income is the average of the adjusted total income of last 3 years. If last 3 years data is available, if last 3 years data is not available, then average of the adjusted total income of last 2 years. If last 2 years data is also not available, then average adjusted total income of last year. So last year adjusted total income will become your average adjusted total income. But remember, this is applicable only if the adjusted total income is negative. If adjusted total income itself is positive, don't do all these things. If adjusted total income is negative, then you have to do all these things. I hope it is clear to all of you. Now let's go ahead with something very important. Now we are going to talk about income which is deemed to accrue or arise in India. First, we have already talked about income which is deemed to accrue or arise in India in section 915, 916 and 917. Now we will talk about when the PGBP income will be deemed to accrue or arise in India, which is mentioned in section 911. PGBP income is accrued or deemed to accrue or arise in India if the non-resident has a business connection in India. If the non-resident has a business connection in India, that income is deemed to accrue or arise in India. Sir, what do you mean by business connection? Business connection means, in general terms, any business activity which is carried through a person. That is, if you are keeping one agent in India and that agent is doing any activity on behalf of you in India, that will be called as business connection. Okay. Now, there are some specific points which will always be taxable in India. For example, if there is an agent which is working on behalf of you in India, who has an authority to habitually means regularly enter into a contract on behalf of the non-resident. So if there is an agent in India who regularly enter into a contract on behalf of non-resident in India, that agent will be called as what? That agent will be called as a business connection of non-resident, and the income of the non-resident will be subject to tax in India. But remember, that agent has to be what kind of agent? That agent has to be dependent agent. He should not be an independent agent. It is written over here. Only dependent agents are included in business connection. Independent agents are not covered. Now, so what is the first case? The first case is very clear. If there is an agent in India who has an authority to conclude contracts on behalf of the non-resident, then that agent will amount to business connection. Second, if he does not have any authority, but he only does one thing, he maintains stock in India and regularly delivers the goods on behalf of non-resident. So now he is not entering into a contract, he is maintaining stock in India and he is delivering goods on behalf of non-resident, then such agent will also be called as what? Will also be called as business connection. Again, the agent has to be a dependent agent. Independent agents are not covered under business connection. Third one, he is not entering into a contract, nor he is delivering goods in India. He is only securing order mainly and wholly for the non-resident. So if he is securing order, if the dependent agent in India is securing order mainly and wholly for the non-resident, that will also be considered to be what? That will also be considered to be a business connection in India. Now suppose if he is mainly ordering for you. You are Mr. A, I am Mr. X. I'm mainly ordering for you, but I'm also ordering for your brother little bit. Then also your brother's business connection will also be established in India, because it is written, if one non-resident controls other, or the other controls the first, or both are controlled by third person, all three parties business connection will be established in India. That is mentioned over here. So to conclude this, there are 3 points which are mentioned over here. First, if a non-resident has a dependent agent in India who conclude contracts on behalf of non-resident, who has an authority to conclude contracts on behalf of non-resident, that amounts to business connection. Second, if a non-resident has the agent in India who has the power to maintain stock in India and deliver goods in India. And third one, the non-resident in India is mainly and wholly securing order on behalf of non-resident, and also on behalf of person who controls him, or also on behalf of person who controls both of them. I hope it is clear to all of you. Now, in some cases, business connection does not establish. Which are the cases in which there is no business connection? No business connection means no income deemed to accrue or arise in India, therefore no need to pay tax in India. The first case, if all operations are not carried out in India, if only part of operations are carried out in India, then only attributable profits will be subject to tax in India. Full amount will not be subject to tax. How much attributable profits will be subject to tax? That is generally mentioned in paragraph 2 of Article 7 of DTAA. Article 7(2) of DTAA mentions the attributable profits which is subject to tax in India. That is not there in your syllabus, so that is the reason we are not talking about it. So, if the entire operations are not carried out in India, entire income will not be subject to tax in India. Therefore, only an attributable portion of the profit will be subject to tax in India. Second. But three incomes will always be deemed to accrue or rise in India. This first one. First one is what? I'll give you example which I've given you in class. There is a Facebook, there is Samsung. Samsung is telling Facebook, I want to advertise in India. Now, Facebook is saying, what is your target customer? If the target audience is Indian audience, for that purpose, if the Samsung is making payment to Facebook, that is deemed to accrue or rise in India. So if you earn from advertisement where the target consumer is Indian consumer, then it is deemed to accrue or rise in India. Second one, a non-resident is purchasing some data from a resident and then selling to another non-resident. So if you purchase a data from a resident and then sell to another non-resident, that is also deemed to accrue or rise in India. Third one, with the help of that data, if you target Indian consumer and sell goods to them and earn money out of it. For example, I am a non-resident, I am purchasing data from a resident and giving to Samsung. Samsung is using that data, targeting Indian customer, earning money from there by selling their phones, and therefore whatever money is earned by Samsung in that process, that will also be subject to tax in India. In box number 3, I have given you 3 big examples for all 3 of them. You can open that example and watch the video. Okay. Next. We are learning the exclusions of business connection. Don't forget. Second, if someone is coming to India for purchasing the goods only for export, a non-resident is coming to India, purchase the goods, export it, no business connection. Next, if someone is coming to India to collect news for transmission outside India, the news channel is coming to India, they are collecting news, but transmission is not done in India, it is done outside India, no business connection. If someone is coming to India for filming cinematographic film, for shooting of film, cinematographic film, no business connection if the following conditions are fulfilled. If the producer is an individual, he should be non-resident, he should not be citizen of India. He should be non-resident as well as a foreign citizen. If the producer is a firm, no partner should be citizen and no partner should be resident. All the partners should be foreign citizen, all the partners should be foreign, all the partners should be non-resident. If the producer is a company, all the shareholders should be foreign citizen and all the shareholders should be non-resident. I hope it is clear to all of you. And last but not least, point number E is only for foreign companies. It is not for all non-resident. A foreign company coming to special notified zone. Special notified zone is where? It is in Gujarat, in Surat, Bharat Diamond Boards, and it is also in Mumbai. I have told you, Bharat Diamond Boards. It is a market for diamond, for uncut and unpolished diamond. So if a foreign company is coming to India in special notified zone to just display its uncut and unpolished diamond, to display what? Uncut and unpolished diamonds, then the activity is confined to that only display, then that is not deemed to income. That is not subject to tax. But yes, if they come to India and if they sell the uncut and unpolished diamonds in Bharat Diamond Boards, then that will be subject to tax. And in that case, if you remember, they have also been given one safe harbor rule that only 4% of the income will be subject to tax. Do you remember? So there are 2 aspects over here. One aspect, if a foreign company comes to India in special notified zone in Bharat Diamond Boards in Mumbai and Surat and they only display, that income is not deemed to accrue or rise in India. But if they come to India and sell their raw diamond, sell their uncut and unpolished diamond, then they have 2 options. Either follow tax as per normal regime or they can also follow safe harbor rule 4% income. This is the kind of interlinking that we are trying to do over here. And last but not least, from 1st April 2022, even significant economic presence amounts to what? Business connection. Sir, what is significant economic presence? Significant economic presence means any person doing any transaction in respect of any good, service, property carried out by non-resident with any person in India, including provision of download of data software in India, if the aggregate payment from such transaction exceeds 2 crore rupees. So if the aggregate payment of the transaction exceeds 2 crore rupees, it amounts to a significant economic presence. Or if the number of users in India is at least 3 lakh, that amounts to significant economic presence. Significant economic presence has 2 criteria. A non-resident is doing a transaction with a person resident in India and the resident in India person is paying more than 2 crore rupees, it amounts to significant economic presence. Or a non-resident has some application like Facebook, Instagram, etc. or any application in which there are at least 3 lakh users, then that amounts to significant economic presence of the non-resident in India. This significant economic presence will be subject to tax irrespective of whether or not the agreements were entered in India, whether or not the non-resident has a residence or place of business in India, whether or not the non-resident comes to India and renders services, or whether they provide services from outside India. Significant economic presence will establish. I have showed you some websites of foreign companies, foreign US companies where they are selling some products in India, and if they are selling the products in India and if they are earning more than 2 crore rupees in the entire financial year, that amounts to significant economic presence. I hope it is clear to all of you. Now there is one small amendment over here that here also if they come to India only for the purpose of purchase and export, so only for the purpose of purchase and export, then that does not amount to significant economic presence. I hope it is clear to all of you. Now Here we complete the business connection concept. Now we will talk about the accrual of other heads. When house property and other sources will be accrued in India. So house property will be accrued in India if the property is located in India, and other sources will be accrued in India if the source of income is India. So if the property is located in India, house property is accrued in India, and if the source of income is India, the income is accrued in India. The debentures is of Indian company. The lottery is earned in India. The bank interest is from Indian bank. Then income is deemed to accrue as in India. Next one, when salary income is deemed to accrue and arise in India, when the salary is earned in India. What do I mean by salary is earned in India? When the services are rendered in India. If the services are rendered in India, it is deemed to accrue as in India. So suppose a Singapore person working in Delhi and he goes to his home for 1 month for the purpose of as a leave. For that leave period also the company is paying him salary. Whether that will also be deemed to accrue as in India? The answer is yes. Whatever salary is paid for rest period and leave period, that will also be amount to deemed to accrue as in India, because that form part of the service contract of the employee. So if he is coming to India for work for 12 months and 1 month he is going out of India for his for meeting his family members outside India, that 1 month salary which the company will pay him, that is also part of his contract. That will also be subject to tax. Next, 913. What if the government pays salary outside India to its citizen? For example, Indian government is paying salary to its employees in USA, in Indian embassy, in Canada, in Indian embassy. That is also deemed to accrue as in India. That is also taxable in India. But only two things are exempt. That is allowances and perquisites which are paid by Indian government is exempt under section 10(7). Salary is taxable. Allowances and perquisites are exempt. I hope it is clear to all of you. And last but not least, 914. Dividend paid by Indian company is always deemed to accrue or arise in India. I hope it is clear to all of you. So dividend which is paid by Indian company always deemed to accrue as in India. It will be subject to tax in India. Let's go ahead with the next section. One hopeless section is there. Section 9A, fund manager of offshore fund. I can plainly say that just ignore this section before the examination. It is not going to be useful in the exam, but anyways, we have to do this for the purpose of revision. Okay, now pay attention please. What is this section? There is a fund outside India which will be called as eligible fund, and there is a manager outside India which will be called as eligible fund manager. Now, if 17 conditions are fulfilled, the income of the eligible fund will not be subject to tax in India. 17 conditions. How to fulfill 17 conditions? 13 conditions have to be fulfilled by the fund outside India, and 4 conditions have to be fulfilled by the manager outside India. Okay. So what are the 17 conditions that we need to see one by one? First of all, the fund management activity through an eligible fund manager not to constitute business connection. Okay. Location of the fund manager will not affect the residential status of the eligible investment fund. So from here onwards, the 13 condition of the eligible investment fund starts. First, the fund should be non-resident in India. The fund should be resident outside India. The fund should be located in a country with which India has a DTAA. Now, the third condition has some serious amendments. The aggregate participation of the Indian residents in the fund does not exceed 5%. So, in the total fund, Indian residents should be only up to 5%. On which date? Earlier it was on 31st March. Now they have checked on 1st April and on 1st October. 2 times you have to check in the entire financial year. So on 1st April, check how much Indian residents have invested in the fund. On 1st October, check how much Indian residents have invested in the fund. On both the dates, it should not be more than 5%. I hope it is clear to all of you. But this condition is not applicable up to 25 crore for the eligible fund manager. So if the fund manager itself is resident, and if he is investing in what? If he is investing in the fund, then he can invest up to 25 crores, no issue. Even if it crosses the limit of 5%, it's okay for him. For fund manager, if it breaches 5%, it's okay. Up to 25 crore, it is okay. For example, the total corpus of the fund is 100 crore and the fund manager has invested 20 crores. So how much fund manager has invested? 20 crore. What percentage it is? 20%. Is it crossing the breach? It is crossing the limit of 5%? The answer is yes. It is allowed for the fund manager. Okay. I hope it is clear to all of you, but this is only allowed for the first 3 years of operation. Now. Suppose on 1st April or on 1st October, you violated the provision. It means 5% is crossing. So you have an option that within 4 years, if you correct that, within 4 months, if you correct that, then it is deemed to be satisfied. Suppose on 1st of April, it is 7%. But within 4 months, that is still 31st of July, if it comes below 5%, that it is deemed to be satisfied. Similarly, on 1st of October, it has become 7%. So within 4 months from 1st October, if it comes below 5% or up to 5%, then it is deemed to be satisfied. Next one, the fund should be subject to investor protection regulations of SEBI. Something like SEBI should be there in that country. The fund should have at least 25 members who are not connected to each other. In the fund, there should be at least 25 members who are unconnected. In the fund, any member along with the connected member should not hold more than how much? More than 10%. One member along with its related party should not hold how much? More than 10%. Then 10 or less members along with their connected members should hold less than 50%. Any 10 members along with their connected members should hold less than 50%. Next, the fund should not invest in any entity 20% or more than 20%. The investment in any entity should not be more than 20%. It can be up to 20%. The fund should not invest in associated entity. The fund should invest in outsiders, not in associated entity. Next, the monthly average corpus of the fund should not be less than 100 crore. So every month, the monthly average corpus of the fund should be at least 100 crore. What if the fund is started in the current year? Then monthly average should not be seen. Then within 12 months, you should reach to 100 crore. Suppose if the fund is started in December, then from December within 12 months, you should reach to 100 crore. If the fund is wound up in the current year, then this condition is not applicable. I hope it is clear to all of you. The fund shall not carry on or control any business in India. The fund should not be engaged in any activity which amounts to what? Business connection in India. And the remuneration paid to the manager should not be less than the amount prescribed by CBDT. So CBDT has prescribed some rules which are not there in your syllabus. So whatever rules CBDT has prescribed, you have to pay that much remuneration to the fund manager. I hope it is clear to all of you. Now E, F and G condition. These three conditions are not applicable to few people. E, F and G. These three conditions are not applicable to a fund which is owned by the government of foreign country or central bank of foreign country. So if the fund is owned by the government of Singapore or central bank of Singapore or government of UK, central bank of UK, then EFG condition is not applicable. For such fund, only 10 conditions are applicable, 13 conditions are not applicable. Next one, sir, what are the 4 conditions that the manager has to fulfill? The manager has to fulfill 4 conditions. First of all, the manager should not be an employee of the fund or connected person of the fund. He should not be an employee, he should be an independent person. The manager should be registered as a fund manager. Further, the manager should be acting in the ordinary course of business. This is his day-to-day job. He is doing as an ordinary course of business. And the manager should not be given profits more than 20%. Up to 20% profits can be given of the fund to the manager, not more than 20% of the fund. Now, whether all these conditions are fulfilled or not, how will the government come to know? For that, the fund has to file a statement with the government of India within 9 months, within 90 days, from the end of the financial year. A statement in form 3 CEK has to be filled with the assessing officer. So the eligible investment fund will fill the form and will give the form to the assessing officer stating that I have fulfilled all the conditions. Okay, I have fulfilled all the conditions within 90 days. If the eligible investment fund does not give the statement, then they will be liable for a penalty under 271 FAB. What is the penalty, sir? The penalty is 5 lakh rupees. A sum of 5 lakh rupees will be imposed on the assessee, will be imposed on the eligible investment fund. I hope it is clear to all of you. Now, some relaxation to a fund manager which is located in IFSC. If a fund manager is located in IFSC, there are some relaxations which are given to eligible investment fund and there are some relaxations which are given to the eligible fund manager. First relaxation is clause EFG not applicable. Just like the fund of the foreign government and the fund of the foreign central government, clause EFG not applicable if the manager is located in what? IFSC. Similarly, condition number K is modifying to similar to 1023 FE. I am not saying that similar point was there in 1023 FE. You can go and check. Same exactly 1023 FE point they have copied over here. Further, for eligible fund manager, the fund manager should be registered as a portfolio manager as per the IFSC Act. As per the IFSC Act, the fund manager should be registered. So this is what this hopeless section is all about. Not very important for examination. You can go through it once. Let's go ahead with the next one, which is a very important section, that is TDS under section 195. Who will deduct TDS under 195? Any person. Any person means any person. The deductor can be any person, resident, non-resident, it doesn't matter. Further, the deductor may have a place of business in India. The deductor may have a business connection in India. The deductor may not have a business connection in India. The deductor may not have a place of business in India. All these things doesn't matter to deductor. The deductor has to be resident or non-resident, it doesn't matter. The deductor may have a place of residence, may not have a place of residence, may have a business connection, may not have a place of business connection. It doesn't matter. Who should be the deductee? The deductee has to be a non-resident of foreign company. The payee has to be a non-resident in foreign company. That is more important. On what amount you are going to deduct TDS? Or payment of any interest other than 194 LB and LC or any other sum chargeable to tax other than salary. The point is very important in 195 when you make the payment to deduct TDS, you have to check whether the sum is chargeable in the hands of the other person or not. The sum has to be chargeable to tax. Otherwise, 195 is not applicable. To deduct TDS under 195, again I am saying, who is the payer? Payer can be any person, resident, non-resident, having a business connection, not having a business connection, having a place of residence, not having a place of residence. Who is the payee? Payee is the non-resident and foreign company. Now, the most important question, that when TDS will be deducted? if the sum is chargeable to tax in India. If the sum is not chargeable to tax in India, don't deduct TDS. For salary don't come here, go to 192. 192 is already dedicated for both resident and non-resident. Along with that, you also have to fill certain form 15CA, 15CB, that also prescribed rules have to be followed over here. Okay, I hope it is clear to all of you. Now, what is the timing of deduction? Timing of deduction here also it is same only at the time of credit or at the time of payment, whichever is earlier. Whichever is earlier, you have to deduct TDS, but in some cases, you have to deduct TDS on payment basis. Which are those cases? If interest is payable by government or public sector bank or public financial institution, then TDS is deducted at payment basis, not on accrual basis. By default, the timing of deduction of TDS is payment or credit, whichever is earlier. But if interest is payable by government or public sector bank or public financial institution, very important point it is, they test this in examination. Then the TDS is deductible on payment basis, not on accrual basis. I hope it is clear to all of you. Next one, 195(6) say was. 195 subsection 6 says that irrespective of whether the income of the other person is chargeable to tax or not chargeable to tax. If it is chargeable to tax, deduct TDS. If it is not chargeable to tax, still form 15 CACB you have to fill. 15 CACB you have to fill whether or not the income, the prescribed procedures have to be fulfilled. Whether the income of the other person is chargeable to tax or the income of the other person is not chargeable to tax. In either of the case, the form has to be filled. Form 15 CB has to be filled and you have to 15 CACB, whatever is the prescribed form, that is required to be filled. Don't be under an impression that the form, prescribed forms have to be filled only if TDS is deductible. Even if nil rate TDS is there, 15 CACB has to be fulfilled by the assessee. Next one, what is 195 subsection 2? 195 subsection 2 says that when you are making a payment to a non-resident or foreign company and the entire sum is not chargeable to tax, then what to do? Then in that case, you have to make an application to the assessing officer. The assessing officer will tell you the appropriate portion and accordingly you have to deduct TDS only on that appropriate portion. You don't have to deduct TDS on the entire amount. Okay. So if you make a payment to a non-resident or a foreign company and if the entire amount is not you are making a payment of 10 crore. You feel that entire 10 crore is not subject to tax. Only some portion is subject to tax. You don't suo motu decide the portion. You give an application to the assessing officer. Assessing officer will determine the appropriate portion and he will tell you by passing an order. After that, you deduct TDS only on that much portion. Don't deduct TDS on the entire portion. I hope it is clear to all of you. Next one. There are some High Court judgments over here. Delhi High Court judgment of Maruti Suzuki where the assessee has made a payment to non-resident agent where such income is not chargeable to tax. No need to deduct TDS. If the income is not chargeable to tax, no need to deduct TDS. And if there is no TDS deduction is required, the income cannot be, the expense cannot be disallowed in PGBP. It's very simple. See, if you are making a payment to a non-resident, first check whether it is chargeable to tax or not. If it is chargeable to tax, then check whether the assessee has deducted or not. If assessee has deducted, great. If he has not deducted, disallow the expense. But if the expense is not chargeable to tax only, then the question of TDS deduction does not arise. Therefore, the disallowance also will not apply in PGBP. Similarly, here also, the payment was made to overseas agent who has not performed any services in India. Therefore, his income is not accrued in India. Because his income is not accrued in India, therefore, there is no need to deduct what? There is no need to deduct any TDS in this case also. To deduct TDS, there has to be an accrual of income of the non-resident in India. Otherwise, there is no need to deduct TDS. So, there are three possibilities. Once you make the payment, you check whether it is taxable or not. If taxable, deduct. If not taxable, not deduct. If it is partly taxable, then make an application to assessing officer. He will tell you the appropriate portion. I hope it is clear to all of you. Next section, very important section 239A. Suppose I am a payer, you are a payee. I am in India, you are outside India. I am resident, you are non-resident. I am making you a payment of 10 lakh rupees and I am bearing the tax. I am bearing. The payer is bearing the tax. So I bond the tax, I paid the tax. Now after 10 days, I realize that, oh, sorry, by mistake, I have paid the tax. By mistake, I have borne the tax, I have grossed up the tax and I have paid the tax and then I realized that I was not supposed to pay the tax. This income is not subject to tax in India. So mistakenly, I have paid the tax to the government of India. Then in that case, what will happen? 239A will come and rescue you. In that case, you have to make an application. If you have borne the tax and you feel that no tax was required, so within 30 days from the date of payment of such tax. So within 30 days from the date of payment of such tax, make an application before AO in form 29D for refund of tax. AO will pass an order, will allow or reject as the case may be. If he allows, great. If he rejects, then go and appeal. If he rejects, he will give an opportunity of being heard and he will pass the order within 6 months. So very simple. If the payer has borne the tax and after that, if he feels that the amount was not subject to tax, the payer has to go to assessing officer within 30 days from the date of payment of tax, make an application in form 29D and ask for a refund. And the department may refund you. If they don't refund you, if they reject your application, they will give you an opportunity of being heard. I hope it is clear to all of you. Next one, very important section, Rule 115. If you are earning income outside India in foreign currency, how will you convert that into INR? You will convert that into INR as per TTBR on specified date. The rate is very clear, TTBR. The date is important. Specified date means what? Specified dates are two dates. Some cases it is last day of the financial year, 31st March 2026. Some case it is last day of the preceding month in which the income is earned. So when last day of the financial year and when last day of the preceding month, we need to check that. For income from house property, it is last day of the previous year. For all PGBP except one PGBP, which will come in point number 2. For all PGBP, it is last day of the previous year. For all IFOs except dividend and interest on security, it is last day of the previous year. So last day of the previous year, income from house property always last day of the previous year. All PGBP except one PGBP, all PGBP last day of the previous year. All IFOs except two IFOs, dividend and interest on security, last day of the previous year. Rest all. That is salary, last day of the preceding month. Interest on security, it is not covered in point number 2. Point number 1, sorry. PGBP in case of NR engage in business of operation of ships. That is 44B, 172, etc. That particular NR business. Last day of the preceding month. Dividend, last day of the preceding month. Capital gains, last day of the preceding month. So just remember point number 1. Point number 2 is balancing figure. Just remember point number 1. What is point number 1? Point number 1 is income from house property, last day of the financial year. PGBP except NR shipping business and IFOs except dividend and interest on securities. Rest all are subject to conversion on the last day of the preceding month. I hope it is clear to all of you. Now for the purpose of deduction of TDS, how to convert, sir? I am making you payment today. I am making a payment of $1 lakh and I have deducted $10,000 as TDS. Now how will I pay that? Will I pay dollar to CBDT? No. You will pay rupees to CBDT. So again you will take TTBR. You will take what? You will take TTBR only. But TTBR on which date? On the date on which the tax is required to be deducted. When the tax is required to be deducted, that depends upon section to section. In some section, tax is required to be deducted on credit or payment, whichever is earlier. On some section, tax is required to be deducted on payment. So you have to check that what is the criteria in your case. If it is required to be deducted on credit, then check the date on which it is credited. On that date, what was the TTBR? If it is required to be deducted on payment, then check the date on which the payment is made. On that date, what is the TTBR? I hope it is clear to all of you. And one last thing in this section, in this chapter, agent. Who can be called as an agent in India? Once they have asked this question, so that is the reason we are doing this. Who can be called as an agent in India? A non-resident is sitting outside India, an agent is in India who will be responsible for all the acts of the non-resident, like filing of return, like recovery of taxes, attending assessments, etc. All those things will be done by the agent in India. So who can be an agent? The following 5 persons can be an agent. Any person in India who is employed or by or behalf of non-resident. Non-resident outside India, employees in India, that can be an agent. Any person who has a business connection with non-resident, that can be an agent. Any person who receives any income directly or indirectly from or through non-resident. If I am in India, non-resident outside India, I am receiving any income from him, I can be called as an agent. Any person who is the trustee of the non-resident. Non-resident outside India, I am the trustee of non-resident, I can be agent. And any person acquires the capital asset in India by transfer, whether resident or non-resident. So if I am in India, I am buying some capital asset from non-resident, whether I am resident, non-resident, doesn't matter, I can be called as an agent. These 5 people can be called as an agent. And these 5 people can be responsible for a lot of things under income tax law, like for attending assessments, for recovery of taxes, for filing of returns, for replying to notices, etc. All those things. Now, one person cannot be called as an agent. Suppose there is a broker in India and there is a principal outside India in UK, and there is a broker in UK also. And the broker in India is not dealing with principal. The broker in India is dealing with the broker in UK. He is not directly dealing with the principal, but he is dealing with the broker in UK. So in that case, he cannot be called as an agent. He cannot be called as an agent. So broker is not directly dealing with the non-resident. The broker is dealing with another broker, and that another broker is dealing with non-resident. So in that case, the broker in India will not be called as an agent. Last but not least, before treating any person as an agent, the officer will give a reasonable opportunity of being heard. Without giving an opportunity of being heard, you cannot treat any person as an agent. I hope it is clear to all of you. So this is what this exhaustive revision of non-resident taxation is all about. I had tried to cover every aspect that I have told you in the class for around 15, 20, 30 hours. I don't know for how many hours we have not done this. In regular batch, we have done this for around 25 hours. In fast track batch, we have done this for around 15, 16 hours. So whatever we have done in 15, 16 or 25 hours, we have tried to wrap up over here in 2.5 hours exhaustively. One more thing I am promising to all of you, all my dear students of South India, mainly in full English, that I will be making one chart also. Comparison chart of all the special tax rates of this section. 115A, 44DA, 115AB, 115AC, 115AD, 115C2I chapter 12A. I'll be making one comparison chart for you all, so that all the special tax rates is in one page. I will try to do that soon, and I will upload a video, and I will also share the PDF of the same with you all, so that all the special tax rates are addressed at one page only. So this is what this revision is all about. Soon I will come up with next revision. Till then, take care all of you. Bye.